Yo, what is up for everyone on the YouTube replay? This one is going to be a little bit different because we're going to be fully analyzing all of the Mag 7 stocks. So, of course, that's Google, Apple, Amazon, Nvidia, Tesla, Apple, and, I'm going to be fully analyzing these more in depth than I normally would on the normal stream. So, yeah, we're going to be analyzing all these stocks first. Then we're going to, do the normal program where we look at a lot of y'all stocks. So, here is the Mag 7. I can't believe it, but Google has passed Apple in market cap. I mean, Google's coming for Nvidia. Google's worth 3.95 trillion. But let's start off the analysis with Amazon stock. We'll just pick a random order here. And I'm also going to be explaining why we're not really in a bubble. And I think valuations on the SPY and all of the Mag 7 could go higher, all of them except Tesla. But check out Amazon right here. If you look in the middle, the forward PE is a 32. So that's pretty fair for the growth behemoth of Amazon. I want to show you all the metrics I look at when analyzing a stock. So check this out right here. First off, we can see the revenue. It's up 13%. I like the double-digit growth. Like, it's hard to grow this already. The law of large numbers, but Amazon still grew the revenue from 158 billion to 180 billion. And they didn't just grow the revenue, but also the net income. Check this out. This is why Amazon is so great. It was a tough buyback here. They were really choppy with their bottom line, sometimes losing net income. But check out their net income in the most recent quarters. It's just up and to the right. And that means margin expansion. They now have double-digit net margins. And when you have, even if they grew their margin by 1%, when you're doing 180 billion of revenue, that extra 1% margin just adds so much money to the bottom line. So anyway, I love Amazon for the margin expansion. They have so many businesses in one. And check out this fortress balance sheet, actually. They're deleveraging. Look at this asset to liability ratio. Went from 55 to 49. So really impressive. And also, if you have Amazon as your competition, you can't outspend Amazon. Check this out. This is their cash from investing activities. Every quarter, they're literally spending $30 billion on new investments. You want this to be negative. If this was a positive number, that means they're like actively selling out of their assets. But let me show you some more metrics right here. Amazon on the left here has $94 billion of cash. So $94 billion of cash and total debt of $74 billion. But they do have a net cash position. Yeah, they have a lot of debt, but check out the trend of this debt right here. It's just down and to the left. They have 6% less debt after they paid off 14% less. Like, look at their total debt from 2022. They used to have over 100 billion of total debt. Now it's just down and to the left because they're making so much net income, they don't need to. Yeah, we can see their net retirement of debt. It's always a net negative right here. They've just been paying off debt like crazy for the past couple years. They don't pay a dividend, and they do issue some shares. The total common shares outstanding, you've been diluted 1.7% year over year, but that's no big deal. They'd also be one of the biggest REITs. Amazon literally has in property, plant, and equipment 407 billion. So Amazon is a phenomenal Mag 7 to buy, never sell. And hey, what's up, Sermon? And what's up, everyone? Lulu. We're going to be analyzing the Mag 7 stocks first, then we'll get into some of y'all stocks. So it's going to be a minute before I analyze some of y'all stocks. What's up, Looney and NOG? What's up, man? Good to see you, Vicky. So, yeah, that's Amazon right there. Well, I do own this one. I'm totally biased, but I just bought another share of them. A 32 forward PE for fundamentals like that. That's why I still think Amazon could even go up higher in a forward PE. So next up, let's analyze Google. I mean, this one is the talk of the town right now because they just passed Apple in terms of market cap for the first time since 2019. They're almost worth $4 trillion, and we are up a good chunk on them. Google, we're up 101% on them, and I think they're just going to continue to climb higher. Obviously, I'm not going to allocate any new money toward Google since I'm already up so much, but this is one you just can't bet against. And look at the forward PE. It's actually cheaper than Amazon. Can you believe it? That's what's kind of crazy. Google is at a 30.6 forward PE, and the market cap is at 3.95 trillion. So Google literally an ETF in one. With YouTube, they own Android. The Google Cloud. They have the third largest market share. The Google Cloud is growing like crazy. But yeah, advertising behemoth. Quantum chip play, TPU play. I mean, they're getting so many TPU orders right now from like Meta, which is gonna add even more to the bottom line. They're also own Waymo. Waymo is like coming for Uber. It's just crazy how much stuff Google does, and I'm missing a bunch too. AI played, Google Gemini. They're basically a mini OpenAI in one. Google's a mini, ChatGPT. They have almost the same amount of, monthly active users. Let's see if there's some Google Gemini AI gains momentum against ChatGPT. Gemini web traffic increasing 24% month over month. So I know they have like 650 million. EU to rule on Google's. Yeah, Google is acquiring Wiz right here. That'll put them in the top 10 largest cybersecurity plays. But anywho, look at Google's revenue. For the first time, it hit 102 bill. They did 100 billion of revenue just this quarter. And in terms of net income, check out the net income every quarter. You won't believe it. Literally doing 25 to 35 billion of after-tax net income every quarter. And the cash from operations as well, 48 billion cash from operations. Like, I couldn't believe the number. So they can easily afford these investments, go to their cash from investing activities, also spending a lot of money on AI right now. 25, 27 billion just this quarter. But they're also super shareholder friendly because Google pays a dividend. Remember, we just saw Google makes on average, 25 to 35 billion of net income a quarter, after tax net income. What are they doing with all that? Well, they pay a dividend. And look at the top. Google's dividend is so cheap, it only costs 2.5 billion a quarter. So they could literally afford to triple, quadruple the dividend right now. They just choose not to and instead choose to invest it in AI. They're also doing massive share buybacks at the top here. Literally, they did 11 billion this quarter. They slowed it down because they're spending so much on AI, but they're normally doing literally $15 billion of share buybacks every quarter. And they've been doing that for all of eternity. Like the buybacks they did back here, like they literally bought back like 5% of the company down here at like 160, and then another 5% down at like 111. And it's so accretive to right now's current stock price. So the thing is with Google, it's cheaper than Meta. That's why I think this one's probably just going to continue to climb higher. It used to be seen as an AI loser, now an AI winner with a 30 forward PE. That's pretty impressive. So let's actually go over Apple now. AAPL. Ooh, and then we got to get to Meta. Meta would be a cool one. What up, OLP? What's up, y'all? We're analyzing the Mag 7 real quick. Then we're going to get into some of y'all stocks to analyze. We got a few more to go here. Yeah, CEG looks like a steal. I'm actually so close to buying a share. So here's Apple right here. Apple has been rewarded for not spending so much on AI. If we look at like Meta stock has been hit hard, but Apple's not super expensive either. A 31 forward PE. That's actually Google slightly cheaper than Apple in terms of paying for the growth. But yeah, obviously we know a lot of people are locked in the Apple ecosystem. That's kind of their moat. We can see their smartphone market share, 17% smartphone market share. They also make the chips, so they have a smartphone chip market share as well of 14%. But yeah, literally half their revenue comes from the iPhone. Literally, people every year always love buying the new iPhone, but the iPhone sales have been flat or like single digits. If we kind of look, this is on the full year, like 2022, it was 205 billion, and this year it's 209 billion. So it's kind of been flat for a while, but they don't make a crazy margin selling the hardware. Where Apple makes all the money is the Apple services. If you go spend $100 in the App Store, Apple keeps 30% of it as a service fee, a developer fee, and it's all super high margin for them. So the services revenue has just been up and to the right as people buy stuff in the App Store, and it's also the iCloud revenue. So yeah, services has been up and to the right. It's over 100 billion of annual revenue. Then they have like the wearables, the Mac, the iPad sales, more hardware. But here's also why Apple's been, they used to be, the tariff fears are all gone now, but they used to be so affected by tariffs because look at this. I always thought it was more, but 36% of Apple's revenue comes from the US. I always thought the US was like 50% of them. But yeah, the US is 36%, EU is 26%, China 15%. So, the iPhones are so secure. In the US, we ban Chinese phones because they're all spyware, we say. But in China, since iPhones are so safe and not even Apple can access the back door, China actually allows Apple iPhones over there. But check out the bottom line. Here's Apple's bottom line. It's phenomenal. They easily make 25 to 30 bill of net income. It's after they pay their, operating profit was 32 bill. That's basically the before tax number. The after tax, they made 28 billion. They really are making like 30 billion in net income a quarter. And what is Apple doing with 30 billion net income a quarter? Because they're not spending anything on AI. They actually pay Gemini, aka Google, over $1 billion a year to integrate Gemini with it. Apple isn't developing their own in-house LLM and buying so many Blackwell chips for billions of dollars. But Apple has the largest share buyback program of any company on earth. Check out the top here. They literally spend 20 to 25 billion of net income a quarter on share buybacks at the very top here. We're just going back to 2023 here. For all of eternity, they're buying back so much of their own shares, and they can afford it. Remember, they're making 25 plus bill of net income a quarter. They pay a dividend. The dividend only costs $3.8 billion. They have room to raise their dividend so much. Again, it's just like Google, Meta, they choose not to raise the dividend and instead reinvest so much back into the business. So yeah, I'm curious to see how the new iPhones will integrate the AI. Yeah, we can see the different margins of the hardware versus the services. Services really high margin there. So yeah, that's Apple, a 31 forward PE. I think it's a great one to just buy, never sell, even at its current prices, 31 forward PE. So yeah, we got to do Nvidia. Yes, sir, Sermon. Let's do Nvidia now. And my bad, I'm a little slow. I'm not reading the chat right now. We're analyzing the Mag 7, and then we're going to get into analyzing all of y'all's stocks. I can't wait. We only have Nvidia, Meta, and Tesla left. Hey, thanks, George, for the gift there. I do appreciate that. The melon juice. Hey, I didn't even see that, George P. That was a crazy gift there. I really do appreciate that. If you got a stock you may look at, we'll look at that one. So here's Nvidia. This brokerage is telling me there's a little, what's this forming here? A double bottom. The rise probability is a 95. As you know, we don't do too much technical analysis. We're looking at the fundamentals here. And check out Nvidia. This is why Nvidia, I think even though the market cap is hard, this is law of large numbers is a tough double. Look at the top right. Nvidia's worth 4.4 trillion or 4.5 trillion. For you to double your money, they have to be worth $9 trillion. But I think if you buy Nvidia right now, you're still going to get 8 to 10% of your money back a year because they're just so strong. Let's look at the valuation real quick. The PE ratio or the forward PE is a 28. So look at the current PE. It's a 45, but the forward PE is a 28 because the expectations are just up and to the right. Look at these EPS expectations. It's using these. The EPS year over year is going to go from 76 cents to $1.50. There's still 100%. Like the EPS is still going to grow 100% next quarter and the next quarter. Like we're going to see triple digit EPS growth potentially, if these numbers are right. These are S&P Global's numbers. Like look at the revenue. The revenue is going to go from 44 to 70 billion, as companies are still spending mega amounts of money on their Nvidia chips. So that's why Nvidia even right now is still not overvalued. Just looking at the growth metrics. That's what a lot of people don't understand. And if another company can pull off this sort of growth, they also deserve to be worth 4.5 trillion. Look at these year-over-year growth rates, and it's going to go to 70 bill in 2 quarters supposedly. But yeah, revenue's up 65, after grew 111, after grew 283. Like it's just up and to the right, and it's not like just their top line is growing, but their bottom line. Check this out right here. And look at the total revenue. The revenue was 57 billion. On this 57 bill of revenue, they netted 32 bill. They literally have a crazy 55% net margin. So if you could spend $100 on an Nvidia chip or, ratio, they net $56 in after-tax net income. They made 32 bill after paying, 4 bill of taxes. It actually was a little amount of taxes paid. But yeah, they printed net income 31 billion, and that was totally real. Fortress balance sheet too. The assets are growing and liabilities are shrinking. Look at that ratio. That's the orange number at the bottom. Liabilities used to be 31% of the assets. Now it's only 26. And check out obviously the cash flow as well. The cash flow is very good. They make more net income than free cash flow. But yeah, that's how they're able to make so many investments, and just invest in the future. They have so much leftover money. I think they're doing buybacks too now. Let's see if that is actually reflected. So yeah, the net income's up 65. EPS is up 66.6, so they did do 1% of buybacks. But the EPS growth, that's why I still think NVIDIA has upside, and it's not some crazy overvalued stock right now. We can see their GPU market share right here. That's pretty crazy. 24% of all the GPUs sold are NVIDIA. They have this automotive software. I saw something in the news about that. NVIDIA is always in the news as the world's largest company. Let's see down here. Nvidia unveils Vera Rubin AI platform, and Nvidia unveils Alpha Mayo AI platform to democratize autonomous driving. I do think it's going to be these robotaxis are going to be so commoditized, and that's another issue with Tesla. So let's actually go should we do Meta first? Let's do Meta first. All right, let's do Meta, then we'll get to Tesla. It's so good to see you guys, Marcus and Looney, Milgon, Steven. My bad there. Yeah, Coremedics, I bought a share. What up, Eric? All right. So, hey, Broadcom's almost another Mag 7. I think Broadcom's worth more than Tesla now. So here's Meta Platforms right here, the advertising behemoth. And they actually just acquired Manus, and they actually have a really big market share. I didn't realize it. And not a huge market share, but like 5%, like ChatGPT has like a 60, Google Gemini is like a 30, and then Manus is like a 5 or 6% market share for LLMs right now. I didn't realize how big they were. Oh yeah, Meta delays global launch of Ray-Bans AI because of the US demand surge. That's if you sold in the US, they get a lot higher margins. So I actually really like the new Meta Ray-Bans. I actually just got a pair and they're great. I love them. And Meta's a cheap stock. If we look at the middle here, the forward PE is a 21, for a Mag 7 advertising behemoth like Meta. I think that's very fair. And its current price, it's worth buying right now. I don't think if you didn't have any shares, it's even worth buying it right now. We can see right here their active users. They have daily active users of 3.54 billion. There's some countries like China that doesn't allow Meta apps. So it's like when you exclude that, like 70% of the world is ex-China is like on a Meta app once a day, which is crazy. What they have WhatsApp, Threads. Threads is huge. Threads nearly has the same amount of daily active users as X now. I find myself getting lost on that app sometimes. But check this out right here. Meta hit a $50 billion of revenue this quarter for the first time ever. It was incredible. 50 bill of revenue. But if we go to their net income, it says they only made 2.7 billion. This was a total one-time tax charge adjustment from the big beautiful bill. But that, you have to include that in GAAP net income. But if we look at the operating profit here, their core business, it was actually a record Q3 20 bill. They made, when you exclude this, they made 18 bill of net income. Like it was a phenomenal quarter for them. When we exclude that one-time adjustment, like we can see from the cash from operations as well, $30 billion. I mean, record cash from operations. It's just incredible. And if we go to the cash from investing activities, this is what's being questioned on Meta right now, how much they are spending. Literally all their net income right now. And actually, I'll mention, Meta now has a net debt position for the first time in history with their Prometheus bond issuance. But check out their cash from investing activities. They're literally investing 20 to 25 billion a quarter in AI chips, buying startups. I'm glad that this isn't super high because I like that they're investing a lot of money in the future. We just hope investors are really hoping they can get real returns on this, because if we go to their Reality Labs, like this is Reality Labs right here, like their metaverse, this one has not been too well of a performer. 2021, it's lower than it. The sales are lower than it was in 2021. So I believe they're slowing their spend on the metaverse and investing so much more on AI. I like the new Meta AI glasses. The EPS expectations are great. EPS is going to go from 522 to 630, and they always beat on EPS expectations. Obviously, they just had this one-time adjustment. We can see this on the EBIT as well, earnings before interest taxes. They always beat. So people are still using Instagram, and they're introducing ads to WhatsApp now, which is a nice earnings tailwind, plus the Meta Ray-Ban glasses. I mean, I just think they're really cool, and they certainly deserve a higher PE than a 21.7. So yeah, Meta's great. Meta really is great. So Sermon says he's been buying Meta. Hey, nice. So here's another one. Last Mag 7 here, then we'll get to y'all stocks, is Tesla. I sadly, this whole stream we've been looking at fundamentals and analyzing the financials. When we judge Tesla purely from a financial fundamental point of view, it does not deserve, in my opinion, a 262 forward PE. It is really expensive. I'm talking like, it's a whole mind of its own. And that's kind of another thing here. Like this stock is a mind of its own and fundamentals almost don't matter. So there's almost no point in looking at the revenue here. But let's see their automotive segment. They sell cars, it hasn't seen the best growth. It's okay to have an extremely high multiple. That just means you're going to have a lot of future growth, but we don't really have too much growth right now. Like, check out this quarter, the revenue grew 8% year over year. But look at the previous quarters. It was down 12%, down 15, down 5. These are the car sales, the main growth driver. So the automotive sales have slowed down. They also have their energy and generation business. Hey, that's actually grown nicely, up 43% to a new record this quarter. Last quarter, it was down 7%. But anyway, if we blend those together, revenue's up 11.5. So remember, revenue's up 11.5, but the net income is down by 36. And this isn't some one-time adjustment either. Like, the real core business, it fell 32%. They're actually barely making any money. And they actually had a one-time adjustment last quarter, making their net income look higher. Like, I couldn't believe it. Like, back here, they only did 400, they only literally made 500 mil of profit. And they netted 400 mil on that. So the profits are really struggling here. And but a lot of the growth is going to come, like, a lot of their future EPS is going to come from, robo-taxis and robotics. But I think there's going to be so much competition. Like, Waymo is already winning. Nvidia's coming for the robo-taxi space. Like, they're projecting like they're going to make like 50 cents per mile or something on the EV. I've looked at the EPS projections from like 2028 and stuff, and it's just like a tough story to pay. And if you like their story, you'll love Google's story and Amazon's and Meta's. So that's the Mag 7 analyzed. And remember, I'm also streaming on YouTube. If you want to see my full analysis on the beginning stocks, you can rewind it. My YouTube channel is called Nathan Robert. It's also in the link tree in my bio. Just type into YouTube, Nathan Robert. And let me give you a quick portfolio update. Then we'll look at some of y'all stocks. What up, Zero? Yeah, hey, Costco did blow up. That was crazy. Here's my main portfolio, dividend only portfolio. We're up 0.92% on the day. Google's pretty much at an all-time high. That's our largest holding. Our most recent purchase is one more share of McDonald's. CEG, I'm literally about to buy a share of this one. So CEG, this is Constellation Energy, literally own 30% of all the U.S. nuclear reactors. I was doing more research on them. They basically have these fully amortized nuclear assets that were built decades ago, and literally they just print money every quarter for them, and it's just pure profit. And any like 1% to 3% inflation will make them an extra just 300 mil in net income profit. Like, CEG, I think, is so well positioned. It's a good price right now. The forward PE is a 24. My favorite utility, if you want exposure to utilities, unregulated utility that I think is the most growthiest utility out there, check out CEG. A surprising stock that's been crushing it is United Rentals. They're up 12% year to date. I couldn't believe it. Pretty boring company. It's always the boring companies that do really good. But if we go to our Roth IRA right here, one stock fell 30% today. And this is so weird because I thought everyone already knew this. Everyone investing in CorMedix already knew this, but they lose basically like this government subsidy, this hospital subsidy. It goes away in the next half of 2026, but they also had an increased CapEx spend. So I've always told people you never want this one as a meaningful size position. It is not going to hurt me too much, but I'm not selling out of this one. I actually bought just one more share of them today. So that one was a bit of a disappointment. We also have our Moomoo portfolio right here. It's known as our buy, never sell account, because once we buy a stock in here, we just never sell it. And no real changes in here. I'm thinking about buying another share of Amphenol just because they're so great. And then we have our Webull portfolio. Oh yeah, look at Google. We're 3.94 trillion. It's past Apple. Crazy. So Google's the second most valuable company. And here's our Webull account. We're up 20% all time in here. Nothing too crazy. Sprouts Farmers Market is having a decent day. SoFi is having a recovery after they issued a bunch of debt shares. AbbVie's our newest position here. AbbVie's down 4% on the day. They actually are like doing some acquisition. I don't know. The acquisition is like supposed to like be decreative to the EPS. I really don't know. I haven't looked too much into that, but yeah, AbbVie's a really nice one. All right, let's see right here. Yo, George P, if you're still in here, thanks again for that huge gift. If you got a stock, give me a look at, let me know there. So let's see here. Hey, Free Me, what up, K2? It's good to see you, man. I hope you're having a great day. I do hope CorMedix bounces back. They're trading at a super cheap valuation, but CorMedix, I guess, future outlook into 2027 is real tough. So Costco blew up today. Let's check that out. Yeah, Costco, they are up 4.9% on the day. They actually had some news of like great December numbers. Yeah, right here, Costco reports December net sales up 8.5% year over year. So that's great news. excluding gasoline prices and foreign exchange. So that's great news. Apparently, they had a great December. And Costco, you just can't bet. This is another great example of a boring but great compounder. I think they announced a special dividend as well. They've always been really expensive, sadly. Like, I'd love to own Costco, 44 forward PE. I love it's expensive. It really is. So is Walmart, though. But, they own Sam's Club. Another big one. But if we go to their bottom line, they're easily making like $2 billion of net income every quarter. If you average it out there, easily $2 billion a quarter. And, it's a great business model because customers, you have to pay for a subscription just to get into the store. So you pay for a subscription, and whether you go to the store or not, they still keep that subscription money. And, customers enjoy going there because you buy stuff in bulk. You get good deals. They have a lot of loss leaders like the Costco $1.50 hot dog, $5 rotisserie chicken, which brings customers in. So people enjoy going to Costco, and it's a great company. Just they're expensive, though. Somehow beating up 10% year to date already. That's crazy. What up, RZ? Okay, let's see here. Oh my goodness, you know what? We never even analyzed Microsoft. Isn't that crazy? We got to analyze Microsoft. You know what? I didn't even add that in the title either. How did we forget about Microsoft? Okay, let's analyze Microsoft. This is another stock that just proves why we're not in a bubble, I don't think, and valuations can go higher. They're cheaper than Google and Meta, Google. Microsoft owns, I think, half of OpenAI, or they have the right to buy 49% of it. But they have a 29 forward PE. That is super fair for a behemoth Microsoft, a 29 forward PE. So they're trading at 29 times next year's net income. Their current PE is a 34. So you always look at the forward PE because the EPS is just going to be literally like, check out the expectations. It's going to go from $3.21 to $3.91. There's still a lot of EPS growth for the future. Same with revenue, but they have three main businesses right here. They've converted from a hardware company to a software company because here's their like hardware sales, their PC sales. It's been flat since 2019. It was the same amount of revenue in 2019, so kind of like Apple. So the actual hardware sales are flat, but it's the software they make hecka money on. So think of the Microsoft 365 subscription, like OneDrive, Office, PowerPoint, all that. That software does over 120 billion of annual revenue. It's insane, and it still grows. Like, it's up 16% year over year. After grew 12, after grew 53, like literally crazy. And that's just one part of their business. They also have a huge cloud business. The Azure cloud is also seeing immense growth, up 29%. It does also over 100 billion of annual revenue for them, 106 billion. I think they have the second largest market share behind Amazon. I think it's AWS, Microsoft Azure Cloud, Google Cloud, then Oracle in terms of the market share. But yeah, a lot of Mag 7 market cap has come from cloud businesses. So like AWS is huge. So yeah, and if we go to their bottom line, Microsoft literally has a better credit rating than the US government. That means like Microsoft, they trust more to pay back the loans than the government. So if we go to their bottom line, their net income, they literally make over 25 bill of after-tax net income. That's after they pay a bunch of taxes, $8 billion of taxes a quarter. So like this really is their after-tax net income. And at this growth rate, what's it going to be the same time next year? Because software is so high margin. Like if we go to their net margin, Microsoft, 35% net margin. It's just crazy. Yeah, they do. Oh, wow. They're spending a lot. I didn't realize that. Microsoft spent 35 bill this quarter, 30 billion last quarter on investments. That's actually really impressive. So Microsoft does pay a dividend. The dividend cost $6 billion. Again, they're making 25 billion net income a quarter, so they can easily afford this dividend, and they can afford to raise it as well. And they do a little bit of buybacks too. They're spending like 4 to 5 billion on share buybacks every quarter as well. So yeah, Microsoft, another just AI toolkit for the future. Every company in one way or another uses Microsoft, or their customers do. They have 82.5 million premium subscribers on their Office 365 or Microsoft 365, and they also just rose their prices on that. So I think that's going to be another great tailwind. And they've like rose the prices for their like OneDrive stuff in like literally a decade, and they're like finally raising the prices. So I think Microsoft's in a great position, especially at a 29 forward PE. That's a valuation that just is like fair, All right. Hey, George, he said, what's your analysis on PL Planet Labs? I think Google is the largest shareholder of this company right here. Check this out. If we go to company, we go to shareholder, check that out. You know, the Google parent company is called Alphabet, and Google is the largest shareholder. And oh, speaking of Google, another crazy thing, Google owns around 16% of SpaceX, and SpaceX is about to IPO, or well, not about to, but they're going to IPO at like a $1.6 trillion market cap. Google owns, that's like Google's a space play because they own so much of SpaceX. And they're up literally like 40x on their original SpaceX investment. What happens is, yeah, hey, this is a brokerage right here. Yeah, if you're interested in getting stocks, this is my favorite app right here. That's what we've been analyzing stocks on. Free brokerage is in the link tree in my bio, very first link there, broker called Moomoo. If you want to use my affiliate link, you can just type it into Google, broker called Moomoo. But here's Planet Labs. Apparently, Google's the largest shareholder, which is crazy. They own 10% of the company. I'm not sure what this company does. Looks like they just spent $170 million buying some sort of asset. So yeah, that's why their balance sheet just kind of leveraged up a bit. I wonder what they bought. That'd be interesting. I like the top line sales growth. Revenue's up 33 after grew 10%, after grew 11. So the growth rate's growing. Maybe from the acquisition, are they losing money? So they are losing a bit of money, 60 mil, 20 mil, but as long as, and look at these expectations as well. They've been beating on revenue. This quarter they expected 72 mil. They did 82 million. So that's probably, yeah, that's why they gapped up specifically on earnings day. It always, fundamentals always outshine in the long run. And if you just beat on expectations, yeah, they were expected to lose, earnings before interest taxes, expected to lose 15 mil. They only lost 3 million. So pretty crazy. Actually, that's an interesting one. I don't really know exactly what they do. Maybe you can check out their website right here, planet.com. Earth intelligence, next generation monitoring satellite from Planet. Oh, so some sort of Earth observation satellite play right here. Planet launches 2 additional Pelican satellites. So maybe they're helping out Google Images, making our Google Maps look clearer. Google owns Waze as well. So hey, they got some big deal with Google. Google owns 10% of it. Pretty cool there, George. Hopefully that was helpful there. Did you cover Amazon? We did. We did cover all the Mag 7. We covered Apple too. So yeah, if you missed anything, I really recommend replaying the YouTube stream again. That's the best way to support me if you wanted to. Again, I sell nothing. I have no course, book, WhatsApp. I'll never follow you, DM you. I don't coach. Literally, I sell nothing. Only way to support me is just subscribe to my YouTube channel. It's called Nathan Robert. It's also in the link tree in my bio. So yeah, let's go over here. So I just picked up some ASTS. So this is, hey, speaking of space stocks, here's another space stock. You know what? Let's check this one out really quickly. This one just basically got profitable. So if we go to their expectations right here, look at last quarter, or let me go down here actually. Again, these are, I don't know what I just clicked. Oh no. I just clicked something weird. Okay, we're back. Well, anyway, if we go to their revenue right here, look at this. This is the basically first quarter they've ever had revenue. Last quarter, all the quarters before was $1 million, but this quarter they did 14 million of revenue. And if we go to the expectations, they're expecting 39 million of revenue last quarter if they can hit those expectations. So I think that's why this one is kind of going up. They're pricing in that future growth of them finally having sales. We want to make sure they don't miss on these expectations, but it's certainly a growth story that looks interesting because revenues are going to go from 700K to 34 million year over year. So that's really what you're watching there. Obviously, they're probably burning through a lot of money right now. Yeah, wow. So they're losing like 50 to 150 mil in net income a quarter. I would be careful from the net income losses, but as long as they keep up this top line growth, it should be good. That one's an interesting one. I'd probably keep it as like a small allocation, wouldn't put too much into them. So as a solar play, Marcus said First Solar. Let's check this one out. Sorry if I'm behind on the chat here. I know I'm missing out on so many companies. I do apologize here. Adobe could be an interesting one. So here's First Solar. This is my favorite solar play. If I was going to buy any solar stock, like Enphase Energy or anything, I would buy First Solar. Yeah, I don't see any specific news. Downgrades First Solar to $260. Well, it's $240 today. Yeah, I don't know if there's any specific news on why they fell. I know Enphase Energy fell a bunch yesterday. But anyway, here's what I love about First Solar. If we go to their bottom line, they make the most net income out of any solar stock I've seen. Easily, like these are the kind of company you want to buy, the quality leader that actually makes so much money. They're easily making 200 to 400 million of real after-tax net income every quarter. So that's what's great about First Solar. The revenue is still like the growth is there. The top line, the sales grew 79% year over year. They netted, wow, what was that net margin then? 30% net margin. Looks like the margin did slip a little bit, but because kind of the whole industry, but fortress balance sheet right here as well. 2.4 bill of cash. Are they doing any share buybacks? I mean, we can check that out. Nope, no share buybacks recently. But anyway, what's the forward PE? Whoa, look at that. And it's cheap. The forward PE is an 11.6. So you can buy something at basically 11 times next year's net income and kind of see the EPS. Yeah, expected $5. And if I was a shareholder of this one, I wouldn't be worried about this little dip right here because the fundamentals are so strong there. I can trust holding that one. Yeah, I really like those ones. Okay. Hey, what up, Pup and Roy, Harwin? Good to see y'all. So yeah, I'm not too sure what happened there. Here's another, made 100% with First Solar. Hey, nice there. Lopez said CDNS. This is a big infrastructure play. Cadence Design. I think they're a big partner with Nvidia. Nvidia's always giving them shout outs. Let's see. Vanguard Group discloses 10% stake in Cadence Design. Okay, retains the dividend rights. Cadence Design to integrate NVIDIA CUDA technology into chip design software. Interesting there. Cadence launches chiplet ecosystem with Samsung partners. So yeah, there's I'm not too sure exactly what they do, but let's go look at their fundamentals here because that's what matters. So they are expensive. Yeah, look at that, a 63 forward PE, but the whole industry is expensive. So core electronic design automation, that's 71% of the revenue. Let's check out the annual growth here. So looks like that was growing decently. System design and analysis, that's up 3% year over year. Semiconductor intellectual property. So let's just blend all these together. Let's go to the revenue down here. The revenue's up 10% year over year. After grew 18%. After grew 13%. So they have nice revenue, or they do have a bottom line. So they're making 100 to 200, or actually sometimes 300 mil of net income a quarter. So yeah, 22% net margin right here. They are expensive. It looks like the revenue growth is slowing a little bit, like 10% revenue growth. All the other quarters, it's usually around 20. Actually, the operating profit, though, they're actually printing money. So yeah, they really do have a 60 forward PE. They missed on EPS the past 2 quarters. They beat on revenue, but missed on net income the past 2 quarters. But they beat on EBIT. So maybe it was a little slight one-time adjustment. Anyway, I like this one. I'd try to get it a little cheaper though. A 60 plus forward PE might be expensive. That's like SoFi expensive, and SoFi has better growth. But it's not. It's a completely different business. So anyway, some sort of infrastructure play. Looks like they have a new partnership with NVIDIA, CUDA, and Samsung or something like that. Pretty interesting. Bitcoin. Hey, Bitcoin, we don't really look at crypto on here because there's nothing to analyze. And that's also a really cool feature of Bitcoin. Like Bitcoin can't report, like they can't miss on net income. They can't miss on net margins. Like it's kind of like a catalyst free thing here that is interesting to trade. It looks like there's some technical analysis for me on here. I like how the app does the technical analysis for me because we always look at the financials. I'm not too good at analyzing the technicals, but hey, I guess they're saying there's a triple bottom and the rise probabilities at 95%. But anyway, that's kind of a cool thing about Bitcoin. There is no net income you can miss on. Can you do analysis on PSMT? Yeah, what is this one? I've actually never looked at these stocks. I like looking at new companies right here. All right. Hey, what up, Christine? How much crypto exposure do you have? I actually own no crypto, actually. I have no crypto at all. I'm a fan of the picks and shovels play of crypto, owning the brokerages like Robinhood, Futu. Futu's one actually, they're my largest position in here now. It took over AMD. But yeah, Futu, Robinhood, and I also own Webull stock. I own Webull in my Roth IRA right here. We got 50 shares in them, nothing too big. But yeah, that's kind of like the picks and shovels play of crypto. So here's Price Smart. I think they're like a dollar store kind of thing, or let's see, the stock's at an all-time high. That's pretty good. So congrats if you own them the past year. What's the multiple? A 23 forward PE. The current PE is a 26. So food and sundries, fresh food. So yeah, kind of like a store, just a normal retail store. They sell foods, fresh foods, and then some clothing. Oh, membership income. Let's check that out. How's that growing? Membership income's up 16% after 13. So that's probably a higher margin kind of thing. Health services. So let's see the net income. Yeah, they're making good net income every quarter. 40 mil of net income every quarter. Revenue's up 9.9, and they're netting 40 mil. So yeah, it's a low margin business, 2 to 3% net margins. That's actually what I really like about Sprouts Farmers Market. They're really interesting. The EPS projections are good as well. Maybe they're doing some sort of acquisition because the revenue is going to pop up next quarter, or maybe it's just always I don't know. But anyway, it looks like there's some future growth expected here. Fresh foods, that's up 9.99% year over year. Fresh foods. So yeah, I nothing to complain about there. 23 PE. That makes Sprouts Farmers look cheap. Sprouts Farmers is at like a 15 PE. Okay. Yo, what up, Sked? Um, okay. All right, what should we analyze next? An ETF. Yeah, here's an interesting one, the SPMO ETF. So this is if you don't want to own the S&P 500 or S&P 500 alternative, this is the S&P 500 Momentum ETF, and it has a bit of a different holdings and a different strategy than the main S&P 500, which is market cap weighted. This lets its winners win kind of differently. And check this out. Notice Broadcom, in Nvidia, then Meta are the top three holdings. Notice there's no Apple, no Tesla, no I get no Google in here. It's these right here that have, the semiconductor industry has been booming. So Broadcom and Nvidia are 20% of the ETF. Then Meta, then JP Morgan. A boring JP Morgan has been a surprising performer at an all-time high while paying a 2% yield. Walmart's been a great one. Palantir. So yeah, it's a bit of a more momentum-y S&P 500 ETF right there, and it has outperformed the S&P 500. Pretty interesting there. So yeah, an ETF is just basically a basket of stocks. Palantir. You know what? Let's do Palantir. This one is a defense name. Most of the revenue does come from the government. They're super expensive. Like, this is a stock I'd love to own, but they're too expensive, like extremely expensive. The PE ratio, the forward PE is a 231. So super expensive. And the price to sales, not PE ratio, but the price to sales is 108. So ridiculously expensive, but this is the kind of company that certainly deserves a high multiple. I don't think that high of a multiple, but they certainly deserve some high multiple. So yeah, check out the government revenue right here. A lot of people don't like this one from an ethical point of view. It's a software helping out ICE and stuff. But yeah, the government, a lot of police stations use Palantir, the Navy, the Air Force. So the revenue's up 55% year over year. After grew 32, after grew 12. So like the growth rate is growing on the government side. Like, these are the fundamentals you want to see for a growth stock, and not just the government revenue, but also the commercial side with other S&P 500 companies that grew 73%. I couldn't believe it. Like, that was super impressive, this revenue growth. After grew 26, after 22. So where the growth rate just continues to grow as they beat on every expectation every quarter by a huge margin, most profitable they've ever been. And a freaking fortress of a balance sheet. Literally no debt. This company's chilling on no debt, doesn't owe anyone any money, got $6.4 billion of cash on hand. The cash pile just grows every quarter because they don't have debt to pay. So Palantir's in a great spot, just an expensive company. Actually used to own them, but I sold them for a profit like an idiot. Sometimes your biggest regrets would be selling out of great companies. So let's see, VRTS. What's this one right here? So Virtus Investment and FTAI. What up, Brian Paul? Shout out to the member. That's an aviation play I love. So I haven't heard of this company before. A $1 billion company trading at 8 times PE. So that's a cheap valuation, trading at 8 times PE. What are the expectations here? So this is not good expectations. This is probably why they're trading at such a low multiple, because the growth is going to be negative. Check out what the analysts are expecting, kind of the orange line. The revenue is going to go from 201 million to 188 million. And they've been missing on expectations every quarter, miss on revenue. Looks like we don't get EPS data expectations. Yeah. So there's going to be a revenue decline. Yeah, so it's already seen a decline. The revenue's down 5%. It's supposed to fall a little more. Looks like the profits are slightly down year over year as well, but they're still making money. That's the good news. They're still making 20 to 40 mil of net income a quarter. Just that future outlook is not too bright with the declining revenue. So that might explain it. And they have a 5.3% dividend yield. So maybe they have a bit of a high payout ratio. Looks like it's some sort of asset management company. So that's what you want to be careful with. They kind of remind me of like a T Rowe Price Group. Okay. Okay, my bad. Actually, let's get to SNPS. Let's get to Synopsys right here because I heard this one's in the news right now. Then we'll get to FTAI. Yeah, CRMD. We looked at that one a minute ago. Cormetics had some disappointing results, but I thought everyone already knew that. So let's check out Synopsys right here. Any news? No recent news around the company, but they've had a sharp recovery. So yeah, they gapped down on earnings back here, but they've just been up and to the right. So let's go see. Are they expensive? So they are expensive. If we look at the PE ratio, it's a 64, but the forward PE is 187. So the net income is expected to fall, but maybe it's a one-time adjustment or something. So if we go to their net income, yeah, so here's the expectations. Yeah, maybe this is weird. So look at this. The EPS is going to go from $2.27 to only 30 cents. Yeah, 30 cents next quarter and then 30 cents the next quarter after that as well. It's probably acquisition related. I remember this company now. So, okay, for context, look at the bottom here. This is a market cap changing. They spent $16.5 billion buying a company. And that's why I look at their balance sheet change so drastically from that quarter over quarter. That's because they spent $16 billion buying this company. And they, of course, had to issue, it works perfectly. Cash from financing activities had to issue 15 bill of debt to buy this company. But that's going to change the whole future outlook here. So yeah, the EPS, the net income is supposed to fall. Maybe acquisition related. We can see the revenue is supposed to grow like crazy, obviously inorganically, but revenue is going to go from 1.6 to 2.25 bill of revenue. And yeah, so basically if we remove the little one-time adjustments from this acquisition, we just look at the EBIT, the earnings before interest and taxes, pretty basic here. It's going to grow a lot. It's going to go from 600 mil to 855 mil. Sometimes you got to blend all these metrics together to kind of get a better understanding because we're starting to realize that, okay, looks like they're going to have some decreative EPS quarters from this acquisition, but the earnings before interest are going to be great when you exclude those. So interesting there. I wish I could give you more context here. I wonder what they spent $17 billion on. They're saying this is like a software used to design and test circuits. It also offers semiconductor intellectual products. So interesting name there, Synopsys. Hopefully that was somewhat helpful there. Sold SIDU way too early. Hey, what up, OLP? So okay, let's get to FTAI right here. I actually really like this name. One of my favorite aviation plays. Wow, they're at an all-time high. Dang, I was real close to buying this one. So this is a cheap, honestly, forward PE for the kind of growth this company has and the industry. This industry always trades expensive. The forward PE is a 36. I remember looking at this one right around like 160, 170, and now it's 230. So it's probably tough to buy meaningfully at this all-time high level, but I'd certainly keep this one on the watch list if you like aerospace and defense names. Check out their aerospace products growth. This is what you want to see. This is the kind of, these kind of fundamentals are like justify the high multiple, and it probably explains why the stock is just probably going to continue to climb higher and higher. The aerospace products grew 71% year over year, after grew 115, after grew 250, like literally from zero. Like in 2021, the revenue was 7 mil. Then it just hits a new record every quarter. Every quarter. Now it's 500 million just this quarter. That's 2 billion annualized. What's the market cap on this one? 23 billion. So that's still fair. We can see the expectations are up and to the right as well. For the EPS is going to go from 95 to $1.50. The revenue too, and they always beat. So, and they're profitable right now. Yeah, if we go to their bottom line, they're already making 100 to 200 mil in net income a quarter, and at this crazy growth rate. I just love growth, and they have the growth, and they're expensive, but they deserve it. They're a good one. I really like that name. What's the difference between a fund and an ETF? Or I think you mean like an index fund. So yeah, basically an ETF is just an index fund on an exchange. Basically, get it? Exchange traded fund, ETF. So basically, there's no difference in an index fund and an ETF, just whatever exchange you're buying it on. The fees are the same. There's one won't outperform the other. So yeah, ETF, index fund, same thing. If you're on a brokerage, you'd buy an ETF. Like ticker symbol VOO would be the S&P 500. The Nasdaq 100 would be like a QQQM. Okay. Do you only go for long positions or short as well? Yeah, I don't do options. I don't short. I'm really boring. I just really diamond hand great companies, just buy and hold stocks for the long run. And this portfolio specifically, once I buy a stock in here, I can't trim it. I can't take profits on it. So most people, when you're up like 100 or 200% on a stock, you'll trim a little bit, but not in this portfolio. But that's also the reason why, y'all aren't going to believe this, but over the past year, we are up 89% on a return money weighted average. We were doing just as bad during the April tariff dip. We were down 14%, same with the S&P, but we spent thousands of dollars buying the dip and it's just paid off. Mainly Comfort Systems right here. We bought this one literally entirely in February through April, and it's just been up and to the right. Same with Amphenol stock. We bought all our shares down here, and I don't mind dollar cost averaging up. I'm actually about to buy more shares of this one. Hey, this brokerage is telling me that there's a double bottom technicals on that one anyway. You still holding Progressive? Absolutely. Yo, we're about to get a crazy special dividend. Y'all want to see something crazy? Where do we show this right here? Dividends receivable. Check this out right here. We got on the bottom kind of here, they did a special dividend. They normally only pay me 40 cents a quarter, but they did a $13 special dividend. So we're getting $54 tomorrow. And we got a little dividend from Disney as well. But yeah, in this portfolio, I kind of do whatever I want. I can sell stocks in here. I love being fully transparent. If you got any questions, want to see my all-time performance, lifetime, or whatever, we're up 20% all-time in here, which honestly, we haven't outperformed. UiPath has been a big struggle. There's some hidden losses in here. Like we lost a lot of money on ChargePoint, but losing money on those stocks made me learn what I should be investing in. And that's why I focus so much on financials. So here's one that is unfortunate. Hey, Vic. So this is Plug Power. I lost a lot of money on their biggest competitor, basically ChargePoint. I'm not a big fan of the charging industry, electric vehicle charging. Pure commodity, and the end game net margin isn't once you get profitable, you're only going to make a couple percent net margin on these. And here's why Plug Power, in my opinion, is sadly, I hate to say this, but it's uninvestable. In my opinion, look at the market cap in the top right. They have a market cap of $3.3 billion. So the whole company's worth $3.3 billion. In just this quarter in net income, they lost $363 million. That is over 10% of the entire market cap they lost just this quarter. And the sad part is, it's all these other quarters as well when you stack it up. Like they lost 360 mil this quarter, which is 10% of the market cap. That's kind of how I like to look at it. They lost 10% of the market cap. The quarter before they lost another 7%, then 5%. Then they lost 1.3 billion. This is the kind of stocks you have to sadly avoid. Go to their net income, see what they've done for all of history. This company just burns net income every quarter. And when I first started investing, I never looked at that kind of stuff. And it starts to, here's ChargePoint. This is the stock I lost thousands on. Check this out. And I'm actually glad I took the loss. Here's where I sold it all. Here's the little sell order. There's my this is a long time ago. We're talking 2023, but we sold it all in 2023. Let's scroll back up here to see where I was buying this. There's one buy order. Look at this. We were buying this stock, they stock split it, but it says like $330. We sold it for a huge loss. And I never paid attention to, another great example, this company's worth $160 million. They just burn through, just for the life of them, so much money every quarter. So that's why I started focusing so much on financials, because that's what you can rely on at the end of the day. So okay, What app is this for the stock? Hey, by the way, or I don't know which app you're talking about. These are all brokerages right here. These are all apps where you buy stocks on. They're all in the link tree in my bio. Not too sure which one you're talking about there. This is my favorite one is the very first link in the link tree in my bio. It's this brokerage right here. It's free. It's my lowest fee, costs nothing. There are no fees, and I like to analyze stocks on here. You get a 3.35% APY. It is an affiliate link, so if you go and deposit $100, they'll both get like some free stock or something. But okay, you can just. Ooh, Netflix. Ooh, let's do this one. Ooh, and Zeta. Hey, Zeta's a cool software name. They've been blowing up, right? Ooh, and Cloudflare, and oh yeah, we still want to get to Cormedics. We'll get to Cormedics again. So here's Netflix. This one, it's honestly, I think it's starting to look like an attractive nibble. Like, you don't want to probably full-size position this. If you wanted this as 5% of your portfolio, maybe don't make it 5% today, but make it 1% because it's a great business model. A lot of people would cancel Netflix last, out of all their subscriptions, they cancel Netflix last. If we look at the valuation, they're trading at a 29 forward PE. That's pretty fair. It's still not super cheap even after the dip, but a 29 forward PE. Historically, Netflix always trades expensive. They sometimes get boycotted and whatever, but the numbers don't lie. They have 300 million premium subscribers. I think they did the Super Bowl, or they had some. Oh yeah, Netflix sets U.S. viewership record with Christmas Day NFL broadcast, averaging 27.5 million viewers live and peaking at over 30 million. 30 million people on Christmas went to the Netflix with the Stranger Things finale. But anyway, they got 300 million premium subscribers. Here's another cool metric: they make $11.69 per month per user, which is pretty crazy. But here's their bottom line: they're easily making $2 to $3 billion of net income a quarter. That's great net income. And Netflix doesn't pay a dividend and they don't do share buybacks. And that's how they're able to, the elephant in the room is this huge acquisition. They're doing this $83 billion merger with Warner Bros. Discovery. That's how they can afford this acquisition, because they don't do dividends or anything. So that's kind of be this is like a whole game changer. $82 billion they're paying. The whole company is worth 350 or 380 billion. So it's going to be like 20% of the market cap. Anyway, there's a kind of like a bidding war right now. What's happening is Warner Bros. Discovery's trying to be bought by Paramount. They bid like $100 billion, but Netflix is bidding like $89 billion. And the more the price goes up, the more decretive it is to Netflix's EPS in the future. So excluding all that noise, they're at a 29 forward PE. Who knows what'll happen with the merger, but it's kind of an interesting one. I think it's starting to work. The risk reward to buy like a little bit is there, I think. Oh, hey, Aaron, what's up, dude? Are you still here? Let me know if you want me to look at LDOS. If you're still here, I got you. I forgot to get to that one. My bad. Let's get to Zeta Global. So this is a cool software name. They're growing. Someone said Elon Musk said to cancel Netflix. Uh-oh. So, they're yeah. So here's Zeta Global right here. Interesting software name. They're not profitable yet. Or they're like just now getting profitable. Check this out. If we go over here to their net income, this is what you want to see. The green, crazy narrowance of losses. Like they used to lose, 40 mil a quarter. But look at these year-over-year declines. They only lost 3 million. And at this growth rate, they're going to be net income positive, for the full next year. But that's why if we look at their current forward PE, it's a 420 forward PE. That's because next year's EPS is going to be so little because there's still some negative net income quarter. So basically, you really want to do a 2 or 3 year out multiple on this one. And that's where I don't know exactly what I should, I don't know how cheap or expensive it is. But let's see. Zeta Global formed strategic partnership with OpenAI to integrate advanced AI models into their Athena platform. That's actually pretty interesting there. With full launch planned by the end of Q1 2026. Pretty interesting there. And they removed the AI coverage, but basically they added like 40 new customers paying over 100K or more in the most recent quarter. Some sort of, AI software company. Yeah, I wish I could give you more thoughts on this one. I really do. I like the fundamentals. I like the growth. They're just now getting a net income positive. The revenue's good. The revenue's up 25%. After grew 42. After grew 20. That's what you want to see. That's great top line growth. We can kind of look at it on an annual basis as well. For the full year 2024, it was a billion of revenue. For the full year 2025, when that gets to next quarter, it's going to be like 1.3 billion. It's going to be even higher. So yeah, Zeta's interesting. All right, let's check it out right here. Um, your price target on the high side. Oh, I forgot what stock we were talking about there. Oh, yeah, let's do LDOS or LDOS. I haven't heard of this one. Can we look at Oracle? Hey, Oracle is an interesting cloud play. It's kind of Let's look at Leidos first right here. Leidos, I think it's pronounced. They're a big company, actually, a $25 billion company, and they're actually pretty cheap. A 17.3 forward PE. At that kind of cheap PE, that leaves so much room for them to stretch up to like a 20 forward PE. And even if they stretch up to a 20 forward PE, which is another, 20% upside from here, it still wouldn't even be expensive. But let's go see what they actually do. So yeah, this company probably easily has the ability to like stretch up to like a 20, 22 forward PE, or even probably more upside potentially. Let's see what they do. So they're a national security company. Okay, so single digit growth, that's probably why they're at that 18 PE. So 8% growth after 0.7. I like how diversified that they are. They're also in health. How's that one growing? Also single digit, 6% growth. Defense systems. Now I like that. That one's growing double digit. Up 11.5%, commercial and international. So kind of when we blend all those together, the revenue grew 6.66%. Now that starts to explain, the numbers always do it. That explains why they're at this teen multiple. They probably deserve actually around an 18 to 20 PE because of the single digit growth. We kind of want to see them get more top line growth there. But let's check out the bottom line. So that actually looks great. They're easily making like 300 mil. If you average it out, easily over 300 mil of after tax net income a quarter. Yeah. Yeah. The before tax is 550. So yeah, they make great net income. Let's check out the FCF, which is free cash flow. Yeah. 700 mil of free cash flow this quarter. So that's pretty good. Looks like they even bought a company last quarter there. They spent $300 million acquiring something. I like that. See, that's what they should do with their cash. Since they're such a low multiple, buy other companies. Let's see. Do they do any share buybacks? They pay a dividend. The dividend cost 50 mil a quarter, so they can easily afford the dividend. And they are doing buybacks. Look at that. 90 mil, then 500 mil in Q1 of this year. So interesting name there. Real interesting. Let's see what the expectations are. Real last thing here. They've been beating on EPS every quarter. Check that out by a big margin. They expected 250. They did 280. So that probably explains why, yeah, they gapped up on earnings day right here and are at all-time highs now. So interesting. I like what I see there. Okay. Hey, what up, King? King H, how's it going, man? And Felix said OSI. Sorry, hey, my bad if I missed some stocks. I want to get to all these. We're gonna be live for like another hour. So uh-oh. Look at that, dude. See, TikTok, they're making me fill out a captcha because they're saying I'm AFK or something, but I'm not. Okay. Sorry, if it went blank there, we're back. So here's Cloudflare. And hey, Adrian, he said Qubits just acquired something. Hey, that's an interesting one. Oh, we've got to get to Oracle. Oh my goodness. Okay. So here's Cloudflare. This is a super interesting cybersecurity name and internet play. If you didn't know, it's like actually I think on a peg like price to earnings growth ratio, they're more expensive than Palantir. I love this company though. Literally 14%, and this is a crazy metric and it's really true. 14% of all global internet traffic goes through Cloudflare in one way or another. Oppenheimer forecast 30% revenue growth in Cloudflare, but just kind of think about that. That is crazy. The cybersecurity that they handle. So anyway, if we go to their revenue, it's just been up and to the right. Let's check this out on an annual basis right here. Yeah, even like since 2020, the full year in 2020, the revenue was 430 mil. Then it went to like 650, 970, 1.3, 1.7, and just this quarter it was 562 mil. So it's going to be at over 2 billion, well over 2 billion of annual revenue there. They do some sort of acquisition. Check out the past 2 quarters. They spent like $1.5 billion buying some sort of company. We're in the cash from investing activities. You want this to be negative because if this was positive, that means they're selling out of their assets. But that's why their balance sheet kind of popped up right there. The bad news is they lose actually they only lost 1 million. Okay, so they're losing like 30 to 40 mil a quarter. So they are still losing money. I know they did inch profitable almost at one point, but that's why there is no forward PE really. Yeah, there is no forward PE because they're not expected to get profitable. So that's the one thing that sucks. Like they're not making any money, but it's just such a great quality company. And if you should look up like the Cloudflare lava lamps, where they literally use lava lamps to like randomize, like they literally have a wall of like thousands of lava lamps that they handle internet traffic through. I can't believe the technology. It's pretty fascinating. So anyway, Cloudflare is a really nice cybersecurity play. Great one. Okay, Andy, I'm new to investing and put some into Oracle. I wanted to get to Oracle right here. I sadly don't love this one. Hey, Shark and Water, what's up, dude? He says Lidos is a great company, good security, also developed the TSA equipment. Oh, interesting there. And hey, what up, the Vigilante? We'll look at XLE, ETF. Oh, and Kratos. We'll definitely get to Kratos. My apologies if I'm missing some stocks here. So Oracle, this is a cloud play. Actually they have like the fourth largest market share. The number one market share is AWS, then it's Azure Cloud, then it's Google Cloud, then Oracle. What app is he using to analyze this? Yeah, hey, this is actually a brokerage. If you want to get this app, I'm on Chow. It's actually in the link tree in my bio, the very first link there. But yeah, Oracle, they trade a bit expensive. They're actually more expensive than Amazon, Google, and Microsoft, and they have bigger cloud market share. Obviously, Oracle's more of a pure play, but they trade at a 35 forward PE. They have this unprecedented backlog where like literally a $400 billion backlog, like 300 billion of it's from OpenAI. Let's see. Yeah, there's a lot of Oracle's rising debt sparks concerns over financial management. So they do have a lot of debt. The debt to EBITDA ratio is 3.4 and EBIT covers interest at 6 times. Actually, that's actually being a little generous because check this out. Oracle, here's their net income. They had a one-time adjustment this quarter. Since they made 6.14 billion, they didn't actually. They really made around the normal, probably 3.5 bill, probably a record net income, but they made 3.5 billion of net income this quarter. If they were to pay off all their debt with that, it's actually a little harder because 1.45 billion of net income every quarter goes to their dividends. So this company has a pretty big dividend, given the market cap. What's the yield here? Yeah, 1% dividend. So you get a 1% dividend. I actually don't like the really high dividend because 40% of all their net income and earnings go to that dividend. And that makes it harder for them to invest in the future, invest in, new assets. Yeah, there's Lawrence Ellison. He's one of the richest guys in the world. He's kind of back in the Paramount Skydance deal. He owns 40% of Oracle. That's crazy. So he owns 40% of a $542 billion company. Also, Oracle owns 15% of TikTok US, which is only 15%. So I wanted to see more news here. So anyway, I'm not too interested in Oracle. AWS, I think, is probably better. 35 forward PE, but there is a lot of growth. Cloud and software, it's still going to grow double digits, and they have this backlog for OpenAI. It's a mixed dilemma where I just don't know. I wish I could. I don't want to like just be bullish to be bullish, but I don't love its 35 PE. Like they're not cheap, and it's interesting. Hey, what up, Nick? Yeah, I am feeling better. Yeah, like last week, y'all, I didn't stream for like a whole week because I was super sick with the fever. Then I got COVID, so that was fun. Wassinator, what's up, dude? Oracle's leaving California, maybe for tax reasons. That's interesting. OIS, what is OIS here? Oil States International. Oh, so this is like the literal oil play. This is like the commodity of oil. You're not buying this to really outperform the tech-heavy S&P 500. This ETF or this stock is the same price that it was back in 2004. But it has done great, because the price of oil has been popping up on the Venezuela news. But I'd pick one that, I'd just pick an ExxonMobil over that probably, is like whenever oil goes up, Exxon goes up a little more. And then when oil goes down, Exxon goes down less. And we can kind of see it's actually nearly at an all-time high today, ExxonMobil. So you might, and you get a yield at 3.2% yield. So how do you get Moomoo AI to tell you the news, bullish or bearish? So yeah, you just scroll down. It's only on some stocks if there's actual news. So yeah, if you're looking at that, I really like that feature. But yeah, if you like go to Amazon, you just kind of scroll down and then there's this Moomoo AI news. It's kind of cool. Amazon launches Alexa.com for, oh yeah, they're bringing back Alexa. Interesting, to compete with like chatbots. AWS partners with Umovo. Amazon's an ETF in one. We just did a full analysis on them. I love that one. Um, okay, yeah, if you want to get this brokerage, it's in the link tree in my bio, very first link there. So let's get to Kratos. Oh, what up, Sharkwater? Let's get to Kratos real quick. And what up, Choco? He said REMX. We'll check this one out. And FCX. So here's Kratos right here. The big drone play. This one has a lot of momentum. I actually really like this stock, but it is super expensive in terms of a forward PE. Yeah, the forward PE is a 323. So their current PE is an 805 for the 4P. So there is a lot of growth. Like the net income's supposed to more than double. Let's see that. Yeah, EPS is going to go from since the stock split so much, it's only 1 cent. But yeah, it's going to go from 1 cent of EPS to 5 cents. We can probably look at that. But yeah, so they're barely making any net income. Like if we look at the net income, I like that it's positive every quarter, but it's a couple million, 9 mil this quarter, 3, 5, 4. But they actually had this government contract. Here's their drone revenue. That's their unmanned systems right here. That actually hit a record. Actually, that's good news. That's a record 87 mil of revenue. That's the highest it's ever been. Never been higher than that any quarter before. But they actually had this government software, and they were able to negotiate to raise prices on it. And so they've been crushing expectations. Kind of look at the orange line here. That's what the analysts expect. Last quarter was huge. They expected 305 mil of revenue. They did 350. And this quarter, they expected 322. They did 350 again. And the expectations are up and to the right. And if they beat by this much in every quarter, it's the EBIT is supposed to be 11 million. So yeah, the profits are supposed to grow with it. So I love this company. A great balance sheet too. That's a really good balance sheet. It's just super expensive, but they certainly deserve a high multiple. Yeah, those are good. These are good financials. Expectations look great. They beat on expectations every quarter. So, good name to maybe add to the watch list. Hey, what up, Zone? MDA stock. What's this one? Oh, MDA Space. This looks like a Canadian company. Any news around this one? MDA Space wins IDIQ contract for U.S. SHIELD program. That's the Missile Defense Agency. So let's actually check this one out. They're worth $3.6 billion. So let's see. The forward PE is a 32. That's not crazy expensive. So they're a satellite company. 55% of the revenue is their satellite. And kind of look at that annual growth. That's what you want to see here. That's up and to the right. They're also robotics and space operations. That one's also seen some nice growth. And geointelligence. That one looks like it's flat. But anyway, if you scroll down here, the revenue grew 41% year over year. These growth rates in the middle look great. That's probably why they're on my watch list. These are great growth metrics. Revenue's up 41 and their net income positive on that. Yeah, they really are already net income positive, making 20 mil plus in net income. Like that, honestly, I almost like this one more than like a ASTS Space Mobile or something. Because the top line growth is really good. Looks like their margins did fall this quarter. Yeah, but still, this is great money they're making. Investing in the future. Oh, wow. So actually, this is probably a one-time adjustment. They just spent $308 million buying some sort of company. Actually, yeah, I'd put MD. I really like that one. Thanks for that one. MDA is a real interesting one, Zone all day. And they're on my watch list too. Oil State International manufactures oil drill equipment. Oh, okay. Specialized equipment used for offshore. That's, hey, they've been saying drill, baby, drill, and maybe they're buying new drills. Okay, I'm so behind here. I do apologize. We will get to Webull. I love Webull. I bought more of them recently. So here's REMX. This is the VanEck Rare Earth and Strategic Metals ETF. So if you don't know, maybe someone just rang my doorbell, scared me. If you don't know which individual stock to buy, you can just buy this whole ETF right here. It looks like Albemarle, then MP Materials is 6% of the ETF. I kind of don't know which ones to individually pick, but this ETF maybe is just a way to just buy the whole industry. So yeah, rare earth mineral ETF right there. Interesting. So what up, Greedy says FCX, and then we want to get to Weeble too. Super Micro. Oh, I actually just completely sold out of Super Micro. I liked them and I love to own them, but the financials were just too disappointing on Super Micro. I hope I regret selling out of them though. What app is this? Yeah, hey Timothy, if you want to, this is actually a brokerage I'm on right now. If you want to get this app, it's actually in the link tree in my bio, the very first link there. It's a broker called Moomoo. Yeah, and it is an affiliate link, full disclosure. So if you go and like deposit $100, they'll both get like some free stocks. But yeah, my favorite app to buy stocks on and actually analyze stocks is I have all these other brokerages too. By the way, they're all linked up there. Like that, the reason we're not on Robinhood is because you can't really analyze a stock on Robinhood and check out the fundamentals. There is no way to. So this one is just like Robinhood, but there's more tools and it's free, lower fee than Robinhood actually, and you get more stuff. So anyway, link tree in bio, very first link. So here's Freeport McMoRan. Cheap company, actually. Checked it out, a 25 forward PE. This one's probably oil and gas related if I had to guess, but I don't know. It's at an all-time high. But the forward PE is a 25. That implies that this stock is probably going to continue to climb higher. Yeah, the current PE is a 37. Forward PE is a 25, so a lot of EPS growth expected. Yeah, so kind of commodity related. Look at that, rod and refining. Oh, United States copper mines. So they're a copper play. Atlantic Copper Smelting and Refining. So looks like there's some sort of another rare earth mineral play. Let's see, is there any news down here? Analysts raise price targets amid copper market optimism. Copper prices hit record high amid supply concerns and tariff uncertainty. Well, hey, that's actually good for Amphenol too. But anyway, this looks like an interesting copper commodity play. Okay, let's see. Wait, where does the revenue come from again? So the US is 30% of the revenue, Japan 23, then all these other countries. I like how internationally diversified that they are. We can see the net income. They make, this is in USD as well. They're easily making, if we average it out, like $1 billion of after-tax net income. McMoRan. Oh, hey, thanks, Charlie. They also an oil and gas play. Interesting there. So anyway, I actually really like this one. Yeah, they got a 15 to 20% net margins. And then, with the copper at all-time highs, they were saying that the expectations are probably even going to beat these expectations as well. Yeah, good EPS projections there. So yeah, 25 forward PE from it. There's a lot of EPS growth, and it's probably just going to continue to climb higher if I had to guess. Those are good financials. Thanks for that one. Yeah, that's probably one of my favorite copper plays, probably my favorite one, because those are great numbers. Ooh, Jake said SoFi. Let me do SoFi real quickly. And Surf Air Mobility. Hey, what's the ticker symbol for that one there, Honest? We can maybe check that one out. Ooh, Crispy, what's up, man? Good to see you. So here's SoFi Technologies. I do own this one. It's one of the stocks I regret every share I've ever sold of, kind of like Robinhood. But yeah, are they green on the day? So yeah, we're up 360% on them. Same. Some of my biggest regrets are like trimming out of these great companies. Like we used to own like 50 more shares of Robinhood, but we sold it for a 3x gain and now we're up way more. So anyway, here's SoFi Tech. It's a phenomenal growth company, a great growth company. And basically they have their own US banking charter, and the real growth comes from their financial services. This is what, in my opinion, justifies SoFi's high multiple and why they're a great growth company. The revenue's up 76% year over year. After grew 101%, after grew 141, after grew 80, after grew 600. Like it literally hits a new record every year, every quarter, like even on the quarter-over-quarter growth. You can just kind of see at the top here. And, this annualized, 1.2 billion of revenue, it's crazy. It's crazy. So they're not even analysts expected that. So they've been beating on expectations every quarter. That's the orange line. They beat on revenue. They beat on EPS. They beat on EBIT. They beat on every metric every quarter. And the expectations are up and to the right. They're going to have $1 billion of revenue in 2 quarters. So that's why I think people are actually starting to take SoFi seriously. It's a company with great growth, great expectations. They're already making like 100 mil of after-tax net income a quarter. And they did just do some stock issuance. I actually don't mind them issuing stock to raise cash at this price. Basically, what they do is they just raise money and then lend it out. That's just what they do. Yeah, here's their lending revenue. That's also at a record, 493 mil. That's a record of 25% year over year. Like all their businesses just are at a record. Lending, the financial services, and how's the technology platform? Also at a record, 114 mil. Never been higher than that before. So anyway, SoFi's a nice growth name. I probably wouldn't have it as a meaningful size position at this current price, at a 48 forward PE, but they certainly deserve a high PE. And I do own them, so I might be biased, but I do like it. So let's see here. Oh, SRFM. Oh, we found it. Okay, Surf Air Mobility. So this one's a micro cap. I'd be careful. Hey, what's the Medline? Didn't they just IPO, Josh? What was that ticker symbol? What's a good ETF to put 10,000 in? The S&P 500 or the QQQ, QQQM, either one of those. But yeah, this one's worth $200 million. Very small market cap. And so see, this is kind of the tough thing why this one's probably been flat. Like, let's say you buy the whole company for, $200 million. You're buying a company that just lost 27 million, which, is well over 10% of the entire company. You just lost 10% of your entire investment in net income just this quarter, another 10% the previous quarter, then another 10%. So every quarter, unfortunately, they're burning through a lot of net income. But let's see if there's top line growth, because that would save this. Oh, and look at this balance sheet down here. They're really leveraged. Look at that. They have twice as much liabilities as assets. The whole company's worth 200 mil. They got 200 mil in debt and only 100 mil of assets. I really want the revenue to low. So they do have revenue, but it's not growing. Revenue's up only 2.7. Last quarter fell 15, fell 23. So at least, sadly, this one's a tough one. It's a tough one to buy. There's not too much revenue growth. They lose a lot of money. They're worth 200 mil and have lost over 50 mil in net income just this year. Well, actually more than that, 70 mil. So sadly, I couldn't really recommend that one. That one looks real risky, and they're a super small market cap, twice as much liabilities as assets. So that's when you more probably want to swing trade. You don't just buy and hold that one for the long run. You'd want to swing trade that. Yeah, would copper prices be bad for APH? I think it'd be more good than bad, because Amphenol just has like these spools of copper already on hand, but they are down 3% of the day. I think it'd give Amphenol the ability to raise prices, which would be, I think it's a good. So AROC, what's this one right here? Thoughts on semiconductor ETF? Oh yeah, that's another one. Speaking of ETFs real quick, if ticker symbol SMH, this is the semiconductor ETF. And if you're like, I don't know which part of the semiconductors to buy. Do I buy the memory one like Micron because of the memory shortage? Should I buy the manufacturers, the fabs like Taiwan Semiconductors? Nvidia just designs the chip. Taiwan Semi actually makes them all. And so anyway, that's why I love this ETF right here, because it's, first off, no one's disappointed. If you've ever owned this one, no one's disappointed with these results. They're so great. But yeah, it breaks your money up for you into all the top semi names by market cap. So it's Nvidia, Taiwan, then Broadcom, Micron's been crazy, ASML, the lithography company, the chip making manufacturer who makes the chip making machines for Taiwan Semi, and the whole ecosystem. So anyway, SMH a cool ETF, and I guess this brokerage is telling me that there's something here, a little bullish continuation triangle from technical point of view. But anyway, yeah, that's a cool one. And the S&P 500, you can't beat this as well. That's why someone said, well, 10K to put in which ETF? Just the S&P 500, because this right here, oh, hey, watch out for that person in chat there. Hey, watch out for people impersonating me. I'll never follow you, DM you. I sell nothing. I have no course book. I don't coach. I literally sell absolutely nothing. So watch out for people impersonating me. Okay, so anyway, I got him out of here. But yeah, the average retail investor and the average hedge fund cannot outperform the S&P 500's 8 to 10% CAGR. So if you can't beat it on average, own some of it. Don't have it as the backbone of your portfolio. But if you can't, just have it as a little bit of your portfolio, and you'll never feel left out when the market rallies and your portfolio doesn't, because you own some of it. It's a nice little psychological thing you almost got to do. What was that stock we wanted to look at? My bad there. What was it? AROC. My bad there, Crispy. Good to see you. So Archrock. Wait. Actually, he said instead BOTZ. I want to check that one out. BOTZ. Oh, here's another ETF. Okay, so this is the Global X Robotics ETF. An ETF is just a basket of stocks. Let's see what it owns. So its number one's obviously Nvidia. Then I've never heard of this one. It's a Japanese company. They've been doing great. Oh yeah, ISRG. This is another interesting robotics play for the medical industry. ISRG is a great one. So yeah, basically a whole robotics ETF right there. Hey, that one's interesting there. Okay. Oh, Medline. Okay, I wanted to get to Medline. MDLN. I know they just IPO'd. This is one of those like medical delivery companies, kind of like a Cardinal Health. They're just like a Cardinal Health, actually. Let me actually pull that one up. So CAH right here. This would be their biggest competitor. They do the exact same thing, and this is a super low margin business. Check this out. If we go to their net margin, here's CAH. They have literally a 0.7% margin, like a 0.8% net margin. They do 64 bill of revenue and they net just 0.7% of it. But that's kind of the same with Medline. It's a super low margin industry, but they make good money. Actually, let me see what their net margin. Okay, they have a better margin. Actually, they have a 4.5% net margin. Good. That's great news, actually. So yeah, supply chain solutions. Again, they just IPO'd, so there's not too much data we get here. But what's the forward PE if we give one? So their current PE is at 25, so they trade at 25 times PE ratio. US is 93% of the revenue, and yeah, here's their net income. They're easily making over 300 million of after-tax net income a quarter. Revenue's up 11.1. So well, the Carlyle Group is the largest shareholder here. But anyway, that's an interesting one. They're cheap. That's the thing, a 25 PE. There's no forward PE because there's just no analyst giving expectations yet because they just IPO'd. But I'm gonna check the intelligent comments here. Usually, but yeah, he's right. That guy in the comments there. Usually IPOs, they kind of just sell off. They like rally initially, then sell off a massive percent. But I think Medline's not falling a bunch because the valuation's fair at a 25 PE. They really do make good money. It's a good business. Doing better than Cardinal Health. Okay. We forgot to get to Bull. You know what? Let me get to Webull stock right here. I said I wanted to get to that one a while back. My bad there. So yeah, Webull, that's actually, I do own them. I actually own a little bit of them in my Roth IRA. They're expensive. So I wouldn't recommend putting too much money into this name. It's one you want to have as a smaller size position. Check this out. We're down 5%, but it's certainly one I still want to own because I'm more bullish on Webull than the analysts are. So Webull, that stock we're looking at, is literally this app right here, publicly traded. If you look at the top, this app is called Webull. It's literally this platform, publicly traded. I've been using this platform for many years. And what I've noticed is this is why I'm more bullish than the analysts are, is they just added in this prediction market stuff, like where you can do on football games and stuff. And they added in crypto. You see how it says new on events in crypto? They just added all this stuff to the app. And that's where brokerages make a juice of a fee. Because whenever you buy and sell a stock, they make a 0.1% like net gain on that. But whenever you do this prediction market and crypto stuff, they keep a 1% and 2% transaction fee margin. So that's what's led Robinhood stock to just absolutely monster up higher. And Webull is basically copying the successful business model. Webull also, I don't pay for this. I don't do prediction market stuff. I don't do crypto either. But you can also like pay them. They're just like Robinhood Gold, where you can like pay a monthly thing to get higher APY on your cash and stuff. So anyway, what's cool is that's actually another cool thing about this brokerage right here. They don't do that. There is no $5 a month. You just get all the features completely for free. But anyway, that's what I like about Webull. Webull stock specifically, I'm just more bullish than the analysts are because of that prediction market stuff. That's just going to make them so much juice commissions. They're not cheap at a 61 forward PE, but they've just beat expectations. They expected 137. They did 150. They beat like crazy on EPS and EBIT this quarter. So that's why I'm bullish on Webull. And the top line growth is there, 55% growth, and they're getting profitable now. So I do own a little bit of them. Wait, let's see here. What about Sinclair? Hey, give me the ticker symbol for that one. Can you cover XLE? Oh yeah, XLE. What is this one? The energy sector ETF. So this looks like a oil and gas ETF right here. So I'm guessing like Exxon, Chevron. Yeah, look at this. So its top holding is Exxon, then Chevron, ConocoPhillips, Schlumberger, Williams, EOG. It's a great ETF. Like if you just wanted, it probably has a great dividend too. Let's see the dividend. Yeah, you get a 3.2% dividend with this ETF, obviously. So you're not buying this to outperform, the tech-heavy S&P 500, but you get the diversification into oil stocks, and those do good. Whenever tech's usually doing bad, oil usually does good. There's random news like the Venezuela news that randomly sends up oil in a tech-heavy S&P, but you buy it for the diversification. You keep it as a small percent of your portfolio, and in the meantime, you just collect that great dividend, the 3% plus dividend. My way of getting exposure to the industry is actually MUSA, Murphy Oil, or Murphy USA. This one I like specifically because they don't have a high dividend yield. They have a rule where they literally spend all their money on share buybacks. Like, you wouldn't believe it. If we go down here, to the dividend costs them 10 mil a quarter, nothing. The dividend costs 10 million, and they're doing 100 to 200 million of buybacks a quarter. 10 mil of dividends, they make 130 mil just this quarter. So actually, MUSA is, I so wish I bought more of this one. I didn't. It's just been up and to the right since I bought them, and it's such a small position for me, sadly. I think that's going to be like one of the growthiest oil plays. Ooh, someone said, should I buy IEV? No way. Haha, Johan, no way. Okay, yeah. This is actually an MLP, a master limited partnership. So you will actually get a K1 tax. So you're actually not buying shares here. You're buying units. So if you buy a share of this, you'll get sent a K1 tax form because you're a partner in the company, not a shareholder. Let's see, where is Carl Icahn? Yeah, Carl Icahn owns 91% of all the shares. Basically, he just... this is like a dividend trap. They have a 25% dividend yield, and that's after they've cut their dividend tremendously. They just can't afford this dividend that they have. They've never been able to afford the dividend, sadly. Let me actually go see how much the dividend cost every quarter. Dividend cost, it's not going to show it because they're an MLP, but they don't make any net income, and it's kind of just for all of eternity. They just lost net income. So sadly, this is a dividend trap, IEP. Yeah. Actually, here's a real cool one. If you like MLPs, this is a really cool ETF. Actually, you'll like this one. This is the AMLP ETF right here. It owns a bunch of MLPs like Energy Transfer, EPD, MLPX, and you basically get a crazy 8.3% dividend yield, and you don't have to worry about any of the K1 tax form stuff. The reason these have high dividends is because they're MLPs, but this ETF right here, you get exposure to all of them without having to ever worry about the tax form, and you still get the crazy dividends. BIZD is another cool one because this owns a bunch of BDCs, another one of the kind of companies where they literally by law have to pay out 90% of their taxable income in the form of a dividend to avoid taxes. And so that's why this one has an 11.5% dividend that's actually sustainable, because that's just how they work. So actually, you probably want to pick and choose your BDCs, like buy Main Street Capital. What do you think of nuclear power? Should I invest in it? Absolutely. I'm really bullish on nuclear. You guys, this is one of my favorite plays. Actually, it's the only nuclear name you should consider, in my opinion, is CEG, Constellation Energy. They literally own 30% of all the US's nuclear reactors, and they have these fully amortized nuclear assets that were built decades ago that literally just make profit every month, every quarter for them. And they're at a bit of a deal right now. They're down 5% on the day. I am a shareholder, so I'm totally biased, but I own this one because they own 30% of all the US's nuclear reactors. There is no close second. Close second would be, or not, there is no close second, but second place would be a VST, a Vistra Energy. They own like 5 reactors versus Constellation's like 32 reactors. So largest pure play by far, and they just acquired Calpine, which is $2 accretive to the EPS. So really like that one. Frase, what's up, man? I appreciate that. What do you think of the outlook in 2026? I think we're going to have another good year in 2026. Probably S&P is just going to continue to hit all-time highs. I have 1 kilogram bar of silver, bought for $500. Now it's worth $2,700. Do I buy or hold? Hey, that's a great question. If you need the money, sell. Silver, if you were going to sell silver, it is at literally an all-time high right now. And, you could buy stocks. If you see a better risk to reward, like if you think silver might only give you a couple percent returns for the rest of time from today's price, maybe sell it for a stock and get 8% to S&P. Who knows? I'm buying Apple and Netflix. Hey, nice. Those are 2 great stocks to buy, never sell. DINO. What is Dino? Oh, Sinclair. Okay, we found it. Ruben, what's up? And we'll look at AVY. We'll look at all these military stocks to watch. Hey, Raytheon's my favorite one, ticker symbol RTX. The government or the administration is saying something like they're stopping them from doing buybacks and dividends or something. It's really weird. But here's HF Sinclair. I actually haven't heard of this stock before. They're trading at a really cheap valuation. Actually, check that out right here. They trade at 24 times PE, but the forward PE is a 9.8. So there's a lot of EPS growth expected. Yeah, EPS is going to go from negative 2 cents to making 75 cents. So that's why the PE ratio looks expensive right now, because they had that loss right there. But they're a refining company, marketing, lubricants, and specialties. How's that doing? That's down 5%. Refining revenue probably. So it's oil and gas, probably commodity related. Mid-continent, Rocky Mountains, Northwest Canada. So let's see. Revenue is flat year over year just because the price of oil, but they are starting to make good profits, and the expectations are up and to the right. You know, the EPS is supposed to be another $1.15 next quarter, then 73 cents. So that'll be, yeah, they really do trade at like a 9.8 forward PE, which might be fair for an oil and gas kind of commodity stock like this, because the sales are affected by the oil commodity price. Like, look at this, the revenue's up 0.6 after it fell 19, and after it fell another 15 before that. So, but whenever oil, it seems like an oil and gas play. Do they pay a dividend? A 3.9% dividend yield there too. Nice. All right. Ooh. What is AVY? And I saw AMD too. Should we do AMD? I like that one too. Silver projects. Silver is the truth. Hey, what up, mister? So here's Avery Dennison. I haven't heard of this one before. Let's check it out. So they are a 19 forward PE materials group. Okay, so they sell materials. That has been single digit growth, 1%, single digit growth there. Let's see. Bottom line, they are making 150 to 180 million of after-tax net income a quarter. So they do make good net income, but the revenue growth is slow, only 1.5. What exactly? So packaging and containers. Materials group manufactures and sells pressure-sensitive label materials. Maybe we can check out their website right here. No, you don't get the cookies. Businesses, so I guess they're in all these different industries right here. Well, wait, Walmart and Avery Dennison collaborate to enhance freshness. So from RFID chip or something interesting there. Anyway, we kind of want to see the growth come back, single digit revenue growth, but they have done pretty good the past couple of days here. I mean, they gapped up like crazy on earnings day, and they've just been up ever since, and they're up 5% on the day. I wonder if there's any specific news here. Maybe a price target raise. Nice. Some packaging company. Okay. Caden said Procter Gamble. Which stock was this? Dino? Yeah, hey, if you miss anything, I'm also streaming on YouTube. My YouTube channel is called Nathan Robert. It's also in the link tree in my bio. You can just type into YouTube Nathan Robert and you can rewind the stream. And you can also see my full analysis on the Mag 7. Out of any stream I've ever done, I recommend rewinding this one to the beginning. I think I really did some good analysis, in-depth analysis on all the Mag 7 stocks. So that's the only way to support me, by the way. Subscribe, hit the like button on my YouTube channel. I'm streaming on there. It's called Nathan Robert. So anyway, here's Procter & Gamble, a phenomenal consumer stock to buy. Procter & Gamble touches the consumer way more than like an Nvidia does, because they got so many enterprise customers, and it's really kind of showing how the consumer is doing right now. And I think it's worth buying the dip on it. They own so many billion-dollar brand names like Tide, Old Spice. Oh my goodness, there's someone at the door. Damn. I have to go for a second. Oh my goodness. How is nobody home? Okay, we're back. There's people they like come and service our car, do the oil change, and we were like, hey, if we give you extra money, will you oil change the other car too? And anyway, sorry. Now I'm out of breath. How the heck he's been sitting there? He's been sitting there for 20 minutes since the last doorbell ring. Oh no. Okay, but anyway, let's get back to this analysis. I gotta turn on my fan too. Ooh. Okay. Procter Gamble, a great company with so many billion-dollar brands like Gillette, Tide, Old Spice. So look how diversified that they are. Fabric, home care products, feminine baby products, like diapers too. Whew. And beauty products, healthcare products, grooming. So I like how diversified that they are. They print money. If we go to their net income right now, they print money, but the top line growth has been slow. The revenues, 2.99, 1.7, -2, so single digit growth. But look at this net income. They're easily making 4 billion plus of net income every quarter when you average it out there. And hey, Rand, dude, thanks for all those gifts there. Happy New Year. Dude, thanks so much, Rand. I really do appreciate that. What's this app? Yeah, hey, this is a brokerage right here. It's in the link tree in my bio, very first link there, broker called Moomoo. But yeah, check this out. They're easily making over 4 billion in net income a quarter. And what are they doing with all that? Well, they pay a dividend. And it only costs 2.5 billion. I think that just goes to show how safe their dividend is. Since they have so much leftover money, they're doing buybacks. Look at the top here. Like around $1 billion of buybacks a quarter. So the dividend costs 2.5 billion. They can easily afford that every quarter. So you get a 2.9% dividend yield for around a 50% payout ratio. And you get exposure to all these great brands. The PE is a 19.6. I think that's fair. Procter & Gamble is just a safe stock. You just buy and never sell. So, yeah, but we do kind of want to see the top line start to grow. It's only 3%, 2% growth, but this is the qualitiest name. I'd way rather buy Procter & Gamble than like a Clorox or a Church and Dwight, or isn't that CHD? Yeah, like it's kind of the whole industry. So it's not just like Procter & Gamble's falling right now, or in like a Colgate too, all these staples, Procter & Gamble's the best pick. And it has a higher yield than Colgate too. Okay. Paul, what do you think of OnDOS? I sold at 790. Wait, is that ONDS? Let me know if you're talking about ONDS stock. Yeah, if you guys got a stock you can look at, give me the ticker symbol. We'll check it out. Hey, thanks, Caden, again for the gift there. Sorry I got interrupted. And Rand, too. Thanks for that. I do appreciate the gifts. Happy New Year. Okay. Let's keep going here. Ruben, what's up? Getting said, how about ARGGY? I hope I can find this one. Oh, Aston Martin. So sadly, these luxury car makers aren't making much money right now. So it's a British company. We'll convert the currency to USD. And if we go to their net margin, it's negative now. That's super sad. So look at this. If we go to revenue, the revenue on Aston Martin, the revenue's down 26% year over year. So revenue's down 26% and they're losing money every quarter. That's why you can't, it's so sad. Ferrari would be the way better pick here. I want to check out their website. Yeah. So this really is Aston Martin, their website, and they can't get profitable. So I guess people aren't buying luxury cars as much, but yeah, so the revenue's down 26% year over year. The stock's been really far down. I actually just picked up Ferrari stock, a little bit of them. So they're my smallest position in here. But yeah, I've actually been buying the dip on Ferrari because we just saw Aston Martin's making no money. Well, this company's easily making 400 to 500 mil of net income a quarter. They literally have a 21% net margin. That's phenomenal margins that Ferrari has, especially compared to Tesla too. Tesla's super low single-digit margin on their cars. But yeah, I don't think I'd touch that stock right there, unfortunately. Can we look at Broadcom? Let's do Broadcom. I think they're on a bit of a sale today. Let's check it out. And then we'll also, MCore is a great one. And ONDS, we'll look at ONDS too. Actually, that one's interesting. So here's Broadcom, down 3.7% on the day. A lot of AI names are also down. Is there any news around this one? Broadcom launches APU dual band Wi-Fi 8 devices. Broadcom secures a $21 billion AI chip deal with Anthropic, expands custom AI chips. Yeah, so they make these TPUs TPU, including a Google-designed TPU V7P chips. Yeah, Google's another big TPU play, surprisingly. So yeah, Broadcom, a lot of people know them for their semiconductor solutions, but they have this huge VMware business. So yeah, semiconductor solutions, we can see on an annual basis, that's at a new record. That's incredible. They also have this infrastructure software, which is huge, that it grew from 2023. Like if we look at this, Like it used to be like 1.9 bill of revenue, but now it's rocketed up, 6.94 billion, continuing the growth that it had from the previous year. And they're printing profits. Here's the FCF, which is free cash flow, 7.5 billion, a record free cash flow. The net income was a record too, basically 7 billion net income, or actually probably more like 6.5 billion. But because they had a little one-time adjustment, they didn't actually make 8.5 bill because that's higher than the operating profit. So they had a little adjustment there. So the EPS wasn't actually that. But yeah, if we go to the forward PE, it's a 40. That's not nuts, for this AI growth behemoth, a 40 PE. I think they now have a bigger market cap than Tesla. So they're worth 1.57 trillion. It's kind of like Nvidia with the higher yield, 0.71% dividend yield on Broadcom. In my opinion, they should replace Tesla for the Mag 7. But yeah, hey, what up, tacos? So this actually, let me go to Ondas, then we'll get to MCore. But yeah, here's Ondas Holding right here. They're going up on the whole defense play. I think they make drones or something like that. It's or let's see, Ondas Autonomous Systems right here. So, oh yeah, look at the growth that they've experienced. This is why the stock has done so well. Check this out. The revenue went from literally, $1 million the same time last year to 10 million in the most recent quarter. So let's see, what are expectations here? So basically they're transitioning from a revenue-less company with no revenue, 10 mil this quarter up from, 0 bits of revenue. And check out the expectations. Next quarter, it's supposed to be 17 million. And then 25 million, like it's literally going to go from 4 mil of revenue to 25 million year over year. That's going to be a great comp. And, 25 mil annualized, it's 100 mil of revenue a year. A 5.3 bill market cap. It's tough to pay 5.3 billion for this company, but I can see why this one has had so much successful momentum because the fundamentals are really up and to the right, beating expectations. Revenue expected this quarter was 7 mil. They did 10 mil, which is technically like a 35% beat. So, yeah, I like these expectations. It'll probably continue to do well. This is a swing trade kind of in the long run. You don't want to probably diamond hand this one, but I can see why it's done so good. The numbers always explain it. The expectations are great. If I was a shareholder, I'd hold that one for the next 6 months, as they report those great numbers. So let's get to MCore. This is like Comfort Systems' biggest competitor. The stock looks very similar. A long time ago, Comfort Systems, they were about to go bankrupt in 2008 and sold like 30 of their subsidiaries to MCore. But yeah, this is still a phenomenal stock and with a great valuation. Check out the forward PE. It's a 22.9. Even after all this stock price appreciation, the forward PE is only a 22.9. That is very fair in my opinion. So yeah, they're a mechanical construction. They do MEP work, mechanical, electrical, and plumbing work. And the mechanical and electrical part of that has been booming recently because I'm a believer like electricians, like they're going to be in such demand just from the whole AI boom. And there's a lot of pricing power. But yeah, if we go to this company's bottom line, it's great. They're easily doing 200 to 300 million of after-tax net income every quarter. Yeah, they really do. That's great. The revenue is up 16% year over year after 15% growth. They pay a dividend too. It's a small dividend, but look at the payout ratio. I mean, they can afford to like 3-5x their dividend right now. Yeah, check this out. So if we go to their net income, they're easily making, look at that, 300 mil of net income a quarter, after-tax net income. How much does the dividend cost? They make 300 mil a quarter and the dividend cost 11 million. They could triple, quadruple the dividend to like 40 mil a quarter, to a 1% dividend yield, and it wouldn't even hurt them. And also they're doing share buybacks too. Yeah, look at that. Usually a couple hundred mil of buybacks a quarter. They did it this most recent quarter, probably because the stock was at an all-time high at that time, so they didn't buy back shares, which is smart. So they're not just buying the stock. Anyway, fair valuation, a 22 PE for MCore, that seems fair. Comfort Systems has been the crazy performer right here. They do the exact same thing, but this one's been a little bit more growthy. Yeah, so like if we go to their electrical segment right here, that grew 72% year over year. And the mechanical grew 25, still great growth, just beating an expectation. Comfort Systems has been my best investment ever. I couldn't believe it. They are down on the day. Hey, what up? Luffy said Uber keeps pumping. Absolutely, man. That's why, like, if you're just patient with these companies, like financials always outshine, and Uber's a great one. A phenomenal stock at a cheap valuation. Let's do Uber. Yeah, let's do Uber real quick. And Apple Oven. Sorry if I'm missing some stocks here. I do apologize. So here's Uber at a 26 forward PE. I think that's very fair for Uber, a 26 forward PE. We don't look at their current PE ratio because they had a one-time adjustment. It says this quarter they made $6.6 billion. So it says the EPS was $3.11. It wasn't actually, they didn't make $6 billion, but they really did make $1 billion, and it was a record Q3. So they had a record Q3. Everything is headed in the right direction here. We can see this is a really important metric here. This is their monthly active consumers. So not just monthly active users, but consumers. It's at 189 million when this exact same time last year was 161 million. So 189 million people a month are actively using Uber, which is crazy. They have the main ride sharing mobility business. It's still growing. COVID's gone, but this is still growing. 19% after 26, after 33% growth. And not just the mobility revenue growing like crazy, but the Uber Eats side as well. That's this delivery business. It's up 29% to a record. It's never been higher than this quarter before, anywhere near it. So that's why this is a serious growth company making ridiculous profits, around $1 billion in net income a quarter. They have had some one-time adjustments, so you really just but that's why you don't look at the current PE ratio, because a lot of people are like, hey, an 11 PE, well, it's really a 26 forward PE, and which is still a great valuation. It's not expensive. That's the thing. Uber will probably just continue to climb higher. Just like the business model, they don't own any cars. They don't take on that liability, but they collect a little 100% fee margin every time you book a ride. And they're also diversifying internationally. They're actually now the largest shareholder of Grab. If we go to shareholder down here, Uber owns 13% of the entire company. They're the largest shareholder. Uber owns 13% of Grab. What is this Grab company? Well, they literally do exactly what Uber does. Literally exactly what Uber does. But internationally, like notice the US and Canada isn't on here. The commodity is universally needed of ride sharing, and that gives Uber instant international diversification. So I love Grab. And Uber's just a great safe bet. There's some competition from Waymo but it's the platform that's going to make the money more than the ride sharing. So yeah, anyway, hey, Odyssey, no way. Odyssey with the 11 roses. Good to see you, man. I hope you're having a great day. Uber or Amazon thoughts? Yeah, hey, we just fully analyzed Uber. They're a great one. Amazon as well, they own Zoox, which is kind of an autonomous drive. Amazon just an ETF in one. An ETF is probably going to continue to climb higher. It's at a 32 forward PE. And look at this. There's actually some, what is this? Nvidia's Alper Sparks autonomous driving surge. The world's first self-driving car, AI-capable thinking and reasoning, directly challenging Tesla's FSD system. So I think it's going to be commoditized, and the winner is going to be the platform, where the cheapest one goes to Uber and pays them the most, because that's where the users are. Okay, let's see right here. There's some more wanted. Hey, Rambo, he says VRT, a high PE, but still room to grow. So, VRT, this is your cooling company. Kind of like they do cooling. Let's see if there's any news right here. Data center liquid cooling market approaches $7 billion. Vertiv expects, digital twins, adaptive liquid cooling. So this is like your infrastructure kind of liquid cooling play. Sorry, I'm reading the chat here. I still want to get to AppLovin and it was ServiceNow, some of these other names here. But yeah, Vertiv, they're cheap right now. But there's some news that Nvidia's new chip or whatever, like all the data center stocks fell on this right here. They said the Nvidia Rubin chip doesn't need liquid cooling or something like that. And the stock tanked on that news. Let's see right here. Vertiv Holdings predicted to join S&P 500 with a 71% likelihood, supported by a robust $9.5 billion backlog. Okay, so this company has a huge backlog. Vertiv identifies key data center trends driven by AI and digital twin technology. So they have some adaptive liquid cooling and higher voltage DC power architecture. So yeah, it's like an NVIDIA play. Oh yeah, here's it right here, the neutral news. NVIDIA Rubin chip platform may reduce demand for water chillers in data centers. So a Barclays analyst noted potential challenges for Vertiv's chiller business. So anyway, that was kind of the bad news. That's what I was looking for. Anywho, that doesn't matter. Okay, so the forward PE is a 34.7. okay, 34.7. And check out their products revenue. This is great growth, 35% growth after 20. And they have a $9.5 billion backlog. They have the service and spare business as well, also at a record, up double digits year over year. EPS projections are, up and to the right. The EPS is going to go from 42 cents to 83 cents, so that there's going to be 100% EPS growth coming up. Oh yeah, look at that bottom line. Triple digit growth this quarter. So revenue's up 29, but the profits are up 125. And it really is. Yeah, profits are really up 43% year over year. So that means margins are expanding. Gross margins are up. Net margins are up. Highest net margin ever. It's never been a 14.9% net margin before. And they really did net 400 mil, after they paid 140 mil of taxes. So they're deleveraging their balance sheet. They deserve this high multiple. Wow. Liabilities went from 80% of their assets to only 67 while growing the assets. And they just did an acquisition. They just spent basically $800 million buying some sort of company. I love that they're investing in the future, and they can afford that, from the free cash flow and net income easily. 2 quarters of net income for a great asset, I'm assuming. So anyway, there's your Vertiv Holdings analysis. Hopefully that was somewhat helpful there. Seems like some bad news recently might be that NVIDIA's Rubin chip may reduce demand for water chillers, something like that. Who knows? On that news as well, Amphenol stock tanked, but there was some analyst that came out and said, I wish I could find that news. He said Amphenol is actually going to benefit from this. I'm not going to be able to find it, but okay. AI needs to use less water, but they will still use a lot. Hey, what up, Brian? Yeah. If you're not in Rich Tech Robotics, you'll miss out. Hey, sadly, what website is this? This is actually a brokerage right here where you buy stocks on. If you want to get this app, it's in the link tree in my bio, that very first link there. It's an affiliate link, full disclosure. So if you go and deposit $100, I'll both get some free stocks. But yeah, my favorite app to buy stocks on. And you get a 3.35% APY on your just idle cash sitting there. How are you feeling about Call Main pick? Yeah, dude, Call Main's a great one. They're a commodity stock. Actually, remind me to get to them. I want to get to Call Main. They're at a new 52-week low today. They reported earnings yesterday morning. So okay. What was it? Where was this? Oh yeah, Rich Tech Robotics. Sadly, this is one you want to be very careful with, because if we just judge this one purely off their fundamentals, there's no news either. There's no fundamentals here. If you're looking, if you want a great robotics play, you're looking for a great robotics stock to just buy and never sell for the long run. I don't think Rich Tech Robotics is a one you should pick. They're only worth $790 million. So they're a micro cap, $790 million. I've looked, they have no IP, no patents, nothing exclusive here. They have no revenue. The revenue is literally $1 million a quarter, and it's down 18% year over year. They're losing money every quarter. So, and the expectations aren't exactly good, $1 million of revenue, 2 million. So this is not a great robotics play, but it is a great momentum swing trade stock. There's a lot of volatility around this one. Look at that. It's 16% up today, but I think it's more of a swing trade than a real robotics play. Hopefully that was somewhat helpful there. Like Symbiotic is a great pure robotics play. This one has over 1,500 registered IP and patents. And they actually help out Walmart with their logistics. Check this out. And Walmart loves this company so much that they took a huge stake. Walmart owns 12.3% of all the shares. But yeah, this one has real revenue. Check this out. 500, 600 mil of revenue a quarter. And they have real contracts that they're a real robotics company that. I've watched a lot of their presentations. They really do have the best real little robots. So there you go. Hopefully that was helpful there. Okay, what was that other stock I wanted to look at? Can you look at GE Veranova? Let's do GE Veranova. Sorry if I'm missing out. I'm missing out on so many stocks here. I do apologize. I want to get to Duolingo. Bandit says DXCMO. Dexcom. Hey, we'll get to that one too. I keep saying I'll get to these. I'm so sorry. I've been live for 2 hours now. I've been live for 2 hours. I'm trying to get to all the stocks. I do appreciate y'all being here. If you wanted to follow the button, I stream every day. I sell nothing, no course book. And I only spend 1 minute on each stock. I think that's what people like. I don't spend too much time on each stock. Just a quick little analysis. So here's GE Veranova. Let's see if there's any news around this one. Nope. Or GE Veranova commences operations of a 1.6 in Vietnam, so some Vietnam machine, but this one really benefits from the PJM auction electricity prices, and the electricity prices are at a record. And 50% of the revenues is power business, then they're in wind, clean green energy, and electrification. If we look at their revenue, only 42% of it comes from the US. But check out their number, what they report versus what the analysts expect. This is why they're doing so well on earnings. But this quarter, they expected 9.15. They did 9.96 billion. A huge, like every quarter they're beating on expectations. They beat on revenue, they slight missed on EPS, and slight miss on EBIT, but the expectations are up and to the right. Literally, the EBIT's going to go from 43 mil to 520 million year over year. Next quarter, it's supposed to be $1 billion. Next quarter's EPS is supposed to be $3.11. That's going to be a record EPS. I don't think it's ever been over $3. It's never even been close to, they had probably one-time adjustment, but it's never even been close to $3 before. So there's a lot of future growth expectations that's probably being priced into the stock right now. They're making a couple $100 million net income. I know they make like these gas turbines that were like under every data center, they have to have these, because even if the electricity grid goes down, they turn on these diesel generators, I believe made by GE Vernova, that runs the whole data center. So that's also in demand. Okay. Oh my gosh, I wanted to get to AppLovin too. I so apologize. There's so many great names I want to get to that I'm trying to. So here's Dexcom right here. What is this company? Oh, and ServiceNow. Okay, so a 28 PE. Hey, thanks for subscribing. I appreciate that. Oh, and ServiceNow too. I think ServiceNow is better than Salesforce right now. So yeah, Dexcom, they're actually at a very fair valuation. So let's go see why they're so cheap, because their current PE is a 37, which looks expensive, but the forward PE is a 28. So there is some positive EPS expectations. Yeah, so the EPS is going to go from 27 cents to 46. And this quarter was a big beat specifically. They beat on revenue, they beat on EPS massively, and slight beat on EBIT. So that's interesting there. Yeah, Dexcom, look at that. They did 283 mil in net income, or that was slight at one-time adjustment. They actually only made around 210 mil of net income this quarter, which is still a record, 210 mil. Let's see, what do they do again? So 71% of the revenues comes from the US. What's the top line growth? Hey, that should deserve a higher than like a 28 PE, 22% growth. I think this quarter specifically was very good. It's a medical device company, engages in the design development of glucose monitoring systems. So, Dexcom, the longest lasting sensor ever. So looks like some sort of patch kind of. This is what they sell right here. So yeah, if you're looking for exposure, interesting name there with good net income. They do make good net income every quarter. What's a good enter for Amazon? Honestly, right now is a decent price because it's still like pretty cheap. Amazon's at a 32 forward PE. I just bought another share. It kind of looks goodly timed. I bought a share at 226, and it's just been up and to the right since. I try to get Amazon at 220. But yeah, because it is tough to allocate a lot of new money at this current price, but it's not like they're super expensive. A 32 forward PE, that's super fair for Amazon. So let's, AppLovin and Duolingo and ServiceNow. Lam Research and Monolithic Power. We'll check those two out. So here's AppLovin. This is one of my favorite stocks of all time. I don't own them. I'd love to own them, and I might actually consider them if they dip a little more back to this like $500 level. That'd be a great new position for me if they could get there. So this is one of the most impressive stocks I've ever analyzed. So this is like a pure, this is a growth monster, I like to call it. So we can see the expectations are up and to the right. The EPS is going to go from $1.60 to $3.11. Like every next 2 quarters is supposed to be a record net income. But check this out. The revenue was $1.4 billion this quarter, up 68%. But remember, the revenue is $1.4 billion and they netted $835 million. That's after they paid over 160 mil of taxes. Like they really did net 835 million. So their net margin was a 60%. They have a better net margin than Nvidia does. I can't believe it. I couldn't believe how they're still growing their net margin. It was already great at 40, 50%, but to 60%, And same with the FCF, which is free cash flow, $1 billion of free cash flow this quarter, up 92%. The growth of everything is so good, and it's going to continue to be good. The EPS is going to go to $3, which is going to be over $1 billion in net income. Like, I can't believe it, how good this, like their ads are so good that the SEC is literally investigating them right now because their ads are so freaking effective. So for like data collection practices, the SEC is investigating them. But AppLovin's Axon platform indicates strong Q4 performance. So this is a phenomenal growth stock, and I'd love to get this one. Just top tier, great numbers. So what was that other stock? Okay, ServiceNow. So this is a great, software name. They are expensive. They're actually quite expensive. Even after they've dipped, even though they're on this massive dip, they're still a bit expensive at a, what's the forward PE here? Let's see, a 69 forward PE. The current PE is an 88, so that's still like 30% EPS growth expected. Check that out. They always beat on EPS, which is just net income. They beat on net income every quarter, and it's supposed to be a record 51 cents in 2 quarters. So same with EBIT, like, wow, they really beat good. They beat on revenue, beat on EPS, and they beat on EBIT, all by a good margin. So why is the stock falling? Maybe it's because the whole software industry is struggling. Like even Salesforce is really struggling right now, and it's probably just getting back to a more realistic multiple. But this is a subscription model company. 96% of the revenues are subscription, and it's up 21% year over year. That's really good. I love subscription model companies. 60% of the revenue comes from the US, and check out the bottom line. They're easily making $400 to $500 million of after-tax net income. Easily over $2 billion net income a year. And what's the market cap? 150 billion. So yeah, that 69 forward PE is expensive, but it's a great quality software name. And I love subscription model companies. It's easy to predict, and yeah, nice software name. Morningstar Research. Let's see what they're saying. ServiceNow's superior products led to rapid share gains, exceptional retention in the ITSM market. Additional growth drivers, including customer service and HR service delivery. So ServiceNow. Anyway, it's kind of what the bulls and the bears say. I really like that name. They're just a little expensive, even after a dip. Do you think Tesla's too expensive? Absolutely. Sadly, Tesla's really expensive. What's this one? Daniel said EXK. Oh, a silver play. Okay, so yeah, if we just look at the actual commodity of silver, it's at an all-time high. And so all the silver plays are also doing really great. This one's pretty much at an all-time high. Forward PE of a 22. So yeah, they own a bunch of silver mines. These are the names of the actual mine. I like how diversified that it is. 5 little different, or 4 different. It looks like what's that called? One of those Simon Says, like little ring things. But yeah, so Mexico, Chile, US. So yeah, it's basically a silver play. Right now, they're not making any net income, but looks like the EPS projections are, they're supposed to get, they have missed every quarter, but they're supposed to get EPS positive for the next 2 quarters. They had a big beat on revenue. They expected 124. They did 144. So anyway, if silver does great, this one will just follow that. And another way to get exposure to silver is just search symbol SLV, little commodity as silver. It's done better. But yeah, maybe you can get exposure to silver via the silver mining companies. Maybe you get a dividend eventually with those. So there you go. Hopefully that was helpful there, Daniel. I know it's kind of a silver proxy. Didn't have too much to say about that one. So Lumentum. Hey, Josh, what's the ticker symbol for Lumentum? We'll check that one out. I want to check out MPWR, Monolithic Power. Let's do it, Brian. So Monolithic Power Systems. So this one is at an all-time high. They've done phenomenal. Wow, that's a great looking stock chart. So let's see what they do. They are expensive at a 62 forward PE. So they must have had a one-time adjustment to the net income. Oh yeah, so look at that 1 quarter. It says they made 1.45 billion in net income. They didn't actually that quarter, but it's still super impressive number. So that's why their current PE ratio is artificially low, because they had this fake $30 EPS quarter. But this, even when you exclude that, the business is doing great and they deserve all the stock price appreciation. Like investors know that was a one-time adjustment, but it's still going up because the fundamentals are great. Like we can see right here, check out the orange line. That's what the analysts expect. It's up and to the right. Revenue is 633. It's going to be 737. And they beat on revenue. So they beat on revenue, beat on EPS, and they beat on EBIT, which is earnings before interest taxes. The EBIT's also going to be up and to the right. So anyway, there's just a lot of future growth expected. And look at this monster balance sheet. That's great. Let's see, they got 1.27 bill of cash and no debt at all. So yeah, they're actually earning interest on their cash. At the top here, they're earning 6 to 8 million of just interest on their cash. So the cash isn't just sitting there doing nothing. If that number was negative, that means they're paying negative interest because of their debt. But since they have so much net cash and that interest rates are pretty high, they can earn interest on their cash. Anyway, great expectations. Maybe a little expensive at a 62 forward PE. They certainly deserve a high multiple, but yeah, there's Monolithic Systems. Any news? Nope, no news. Yeah, good expectations there. Oh, actually, I saw Let's do Broadcom real quickly. We already looked at that one, but we can do it again. They're down 3.7% on the day. We'll actually look at a few more here, then I gotta go. We've been streaming for a long time. This has been fun though. I might try and do a later stream later tonight. But yeah, a 40 forward PE, that's pretty fair. For Broadcom, a 40 forward PE. It's actually a bit more expensive than Nvidia. Nvidia is at a 29 forward PE. But this one is just as growthy, and the expectations are great. Look at this. It's going to be 20 bill of revenue in 2 quarters. The EPS is going to be $1.52. They had a one-time adjustment this quarter, but the EPS is going to just go up and to the right, really 40-50%. EPS growth kind of looks cleaner on the EBIT right here. It's going to go from 9 mil to 13.37 bills. So still like 40% growth expected. Like, they print money. We go to the free cash flow. This is what you want to see. 7.5 bill of free cash flow. Every quarter they're making that. And at this growth rate, what's it going to be the same time next year? Plus net income, they're easily making 5+ bill of net income a quarter. They're literally making 20 billion of after-tax net income a year, and more than 20 billion of free cash flow as well. So yeah, Broadcom's a great one with their VMware. They might still be a little expensive, but yeah, their infrastructure software, their VMware business is booming, especially from 2023. Like, just been up and to the right, holding on to the growth from last year. So yeah, EBIT is earnings before interest and taxes. It's kind of a more simpler metric. We're only looking at this to kind of get a better idea of the because sometimes there's a lot of one-time adjustments. Like, so basically, we just like to look at it. You should always really look at EPS. Like the EPS, the net income, GAAP net income, it never gives them the benefit of the doubt. And this, excludes the interest taxes. Sometimes if they make positive interest, the net income will be higher than the EBIT because they make so much positive interest. Or you just got to blend in all the metrics. But yeah, that we were just looking at EBIT to look at the non-adjustments. So all right, and those expectations look great. Okay, LITE. What's this one right here? Hey, what up, G Truth? So, okay, Lumentum stock right here. They have had an insane rally. They're down 11% on the day, but that's after they've tripled in just 6 months. Literally in 6 months, went from 53 to 375. Crazy growth there. Let's see. Is there any kind of well, the expectations are great. Hold up there. Look at that. The revenue is going to go from 425 to 689 mil. It literally record quarters. So EPS too is going to go from -60 to positive 60 cents. So yeah, we can kind of see that on the EBIT as well. So phenomenal future expectations. And that's really what led to all this stock price appreciation. It's really pricing in that future growth. Yeah. So the forward PE is an 87. But yeah, they're about to make a lot of money. The revenue is just going to continue to hit a new rate. There's just a lot of growth here. So it's probably tough to buy it at their current prices, but they'll probably beat on these numbers. Let's see here. Components revenue and systems. So here's where the revenue comes from. Do beware, I guess 24% of it comes from Hong Kong. Then the US is 19%, then Thailand and all these other countries. So yeah, there's ticker symbol light for you. Lumentum, a lot of future growth. I can see why they've done so good. All right. What was this one? Hey, what up, G Truth? mRNA. Hey, well, check out that one too. AMKBY. I haven't heard of this stock right here, but we found it. AP Mahler stock. It's an ADR. Let's see what they do. So so maybe it's a shipping company. So Ocean Logistics and Services, terminals revenue, That revenue is growing like crazy, up 22. That's very consistent growth there. So I guess if there's ever like a lot of supply chain issues, I guess this one benefits, kind of like a Red Sea play. So revenue's down 10% year over year. They're still printing money. I mean, they made a bill this quarter, 700 mil, 1.2 bill, 2 billion. So let's see, they pay a dividend, a 6.9% dividend. Yeah, that's usually normal for these shipping companies. Yeah, so they're headquartered in Denmark. Oh, Macerk. This is Macerk. Oh my goodness. I just realized who this is. Okay, yeah. They have those big cargo container ships. We actually have I want to hold on here. I want to show you something really cool. I actually bought this is so stupid. Okay. Here we go. Check this out right here. It's going to be this is my stream setup, but look at this. I don't even think you can see it. I got my own little Macerk little cargo container there. I got it off Temu. But anywho, actually this is an interesting name there. They make good money, so good balance sheet as well, good dividends. So actually, I'll put them on the watch list. Okay. mRNA. Let's check out this one. mRNA. Yeah, Macerk shipping containers. I don't know why. I thought that was cool to buy. It was like $1. So here's mRNA Moderna. Sadly, this one has been down to the right because they're no longer getting those COVID sales, because that's still like 95% of the revenue was their COVID vaccine revenue, and obviously that's gone. And this is why if you're wondering why is the stock done so bad, you can just kind of see it in the numbers right here. Look at the revenue year over year. It's down 45% this quarter. Last quarter was down 42, then down 35, down 65. And that's after it fell another 45. So they're on a massive revenue loss, and they're losing a lot of money right now. This is not what you want to see. They're losing, 200 mil a bill, like almost a bill a quarter. So look at their assets. Their assets are just slowly going down. Luckily, they can still afford these losses for a bit more time, but nothing's really blowing me away here, sadly. Maybe this is the bottom, though. This will be like a permanent bottom. Maybe the sales are only up from here, but revenue's down bad, losing a lot of net income. I wonder if they have any sort of other prescriptions they're trying to develop. Bayer's files patent lawsuit against Moderna over mRNA technology. Moderna predicts $2 billion for revenue in 2025. Targets cash break even by 2028. Significant cost reductions. Moderna submits regulatory applications for mRNA influenza vaccine in multiple reasons, showing vaccine efficiency of 26%. So anyway, I'd be careful with this one. Yeah, the financials just aren't too great there. I'd probably rather buy like HCA Healthcare. I've been messing with some healthcare names, but AbbVie, that's the one I was talking about. AbbVie, I actually just bought AbbVie for the first time ever 2 days ago. And this one, you get a good dividend if you like good dividends as well. Even if you buy the stock right now, you get a 3.1% dividend. And I actually just made a whole YouTube video analyzing this stock. It's the very first stock we analyzed in my most recent video. If you want to watch it, I explain exactly why this stock will give you a 3% return every year in dividends, and then 4 to 5% in stock price appreciation for an 8% total return a year. So if you're looking for a company with a higher yield, a 3% yield, but will still give you around 4% on top of that stock price appreciation with some growth, check out AbbVie. Another company I think is like that, where you get 3% in dividends and around 4 to 5% stock price appreciation would be a Southern Company. This one has a 3.3% dividend yield. There's very few stocks that have like a 3% yield that will still have growth or more. And I think these are some of the ones if you like more dividend plays. So yeah. IWM stock, is that the Russell 2000? So yeah, this is the Russell 2000 ETF. It basically owns a bunch of small caps. Let's see what's in it. Obviously, each little thing is a small percent. So yeah, Bloom Energy 0.7, Fabrinet, Kratos a good one. Kratos is on here. So basically it owns 2,000 stocks of micro caps. So it's a kind of a different way to get exposure to stocks, I don't love this one versus the S&P 500 because like the S&P 500 will always outperform this because this one doesn't let its winners win. And It has a lot of zombie companies where a lot of the companies in here are pretty much just going to go bankrupt for sure. Oh, I guess we can see all the top. They got Oklo in here. Oh dang, CTRE. Yeah, that one's been great. So anyway, it's at an all-time high today, though. That says something. Literally, it did hit an all-time high today, and today's oh yeah, a lot of the small caps are rallying. Like yeah, like the little drone plays and stuff. Yeah, that's interesting. And the S&P 500 isn't. Can you look at Cake Stock? The Cheesecake Factory. Sadly, I've looked at this stock, and every time I do, like, nothing really blows me away. This stock is lower than it was in 2016. So, and I can see why it's been flat for a decade. It's because they just aren't growing. Like, here's their main business, the Cheesecake Factory restaurants. This is not great. If you look in the middle here, look at these year-over-year growth rates, 0.5, 0.9, 0.7, 1, 3, single-digit growth rates. And it doesn't really beat inflation. They still make good money. Like if you go to their net income, they're still making 30 to 50 mil. Kind of check it out on an annual basis. Yeah, actually, they are really getting back to 2017. They did 156 mil, and they did this year as well. So they do make good net income every quarter, and they can afford the 2% dividend, but they just don't grow. And it's not just like Cheesecake Factory's been flat since a decade ago. It's not like it's just the Cheesecake Factory. It's the whole industry. Like check out like a boring Wendy's. Wendy's has been super sad. Look at this. Wendy's, it's actually lower than it was when they IPO'd in 1997. Like a Jack in the Box too, with ticker symbol Jack. This one's been super depressing. That one's at the same price that it was in 2006. So my favorite play is like a McDonald's or a Yum Brands. Even, Cheesecake Factory had like a 2% dividend yield. You can get that same good dividend with the Yum Brands, a 1.9% dividend yield. They own KFC and Taco Bell, and I guess Pizza Hut too. So, actually this chart looks great. It kind of looks like a McDonald's. McDonald's or Yum Brands I'd probably buy. You get the same dividend and potentially just more growth. Hey, but there is some technicals here. This app is saying that there's some sort of bullish continuation triangle. So yeah. Ooh, a Texas Roadhouse I really like as well. TXRH, they're also, actually they've done really good at Texas Roadhouse. They got great biscuits. They're little rolls. Okay. Which one should we do here? Dat one, dude. No way. The legend Dat one dude is here. I want to get to actually PSIX. Let's do this one real quick. This one is an interesting small cap play. If you're looking for a smaller market cap, this is one I like. They're a $1.4 billion company. So they're pretty small, $1.4 billion, but the valuation's really low. They trade at a 14 forward PE. It says their current PE is at 12. They had a little one-time adjustment last quarter. It says they made 50 mil. They only made 32 mil, but it was still a record Q2. But anyway, it's a $1.4 billion company, and they're making great net income every quarter. Again, 25 to 30 million of after-tax net income a quarter. They're deleveraging their balance sheet like crazy since they're printing money now, these power solution machines that they make. And I really like the 14.4 valuation. All the financials are headed in the right direction. And I think this industry is just going to be in such demand. So yeah, you can check out their website right here. Yeah, 1,500 plus things sold or whatever is said there. So anyway, I would just really like power solutions. I don't have it as a meaningful size position. This isn't a stock you really want as a huge size position. We're still down 3.4%, but I got 5 shares in them. It's a one where I still want to have a little bit of shares of because they seem pretty quality. So like they could go back up to like $100. This app says it's a 12.9 forward PE, so an even lower forward PE. So anywho, that's PSIX. I've just always been impressed with that one. Like your specialty play. Okay, here's another one. SMFG. Mitsui Financial. Well, look at that one. This one's at an all-time high right now. This is probably a bank, or something like that. So the Japanese company will convert the currency from Japanese yen to USD. So America is Japan, 30% of the revenue. Let's see what they do. So the net income is great, and this is in USD. They're making easily like 2.5 to 3 bill of net income a quarter. I assume this is just, yeah, Diversified Bank. So it's just a bank headquartered in Tokyo. So they're probably, these banks always trade around like a 12 PE. So they're, yeah, at a 12.7 forward PE. The industry average is around that as well. So, yeah, they're at an all-time high. They kind of remind me like a JP Morgan. They're just like an international JP Morgan. This whole industry's on fire. Like, look at boring JP Morgan is at an all-time high. Rambo said, do you share your portfolio in your link tree? Well, I do if you go to my YouTube channel. By the way, I sell absolutely nothing. I have no course book, WhatsApp. I'm just on here giving my opinion. If you want to support me, the best way is subscribe to my YouTube channel. It's called Nathan Robert. And that's where I always do crazy stock portfolio updates. And I do it on the live streams. If you have any questions for me, want to see every stock that I own, I have a bunch of YouTube videos where I go over, like I made one like 2 weeks ago where I go over every stock that I own, kind of like a monthly portfolio update. And I do a portfolio update at the beginning of every stream. So if you go to my YouTube channel, Nathan Robert, go to the streams, you can like rewind it. Whoa, Carlisle's up 5% now on the day. United Rentals has been crushing it. They're up 12% year to date. All right. So yeah, if you want to see my whole portfolio, it's just on my YouTube channel, Nathan Robert. It's also in the link tree in my bio. But yeah, just type into YouTube, Nathan Robert. That's the best way to support me. Just subscribe to there. So let's look at a few more here. Juan said URA stock. This is the Global X Uranium, and we'll look at ZBH after this. If you're looking for a uranium play, you don't know which uranium stock to buy individually. Like if you don't know whether to buy Cameco or LEU or UEC, those are the only three uranium names I'd pick personally. But if you don't know which one to pick, you can buy this ETF right here. That's just the literal owns all the uranium names, and it just goes up. So yeah, this is a more diversified way to get exposure to uranium. If I like to pick and choose my uranium names, Cameco is the best pick. Cameco, CCO, UEC is a good one. They bought a good uranium mine off Rio Tinto, and LEU. That's probably my favorite one. LEU is a cheap one, but still, I wouldn't have those as big size positions. Oh yeah, I wanted to get the calm right there. Let's get to this one, Tukey, and then so. This is your chicken egg commodity play. They sell a total commodity, literally just chicken eggs. They have like a 30% market share for chicken eggs in the US, and they traded a 20 forward PE. That's probably fair for Cal Maine because they sell a commodity. There's like a normalization happening for egg prices, so the revenue's down 19%, obviously on tough comps. So revenue's down 19, and they made $102 million net income this quarter. So what was that on expectations? So they slightly missed on revenue, but they beat on EPS and EBIT. So their margins actually was great. So even though they slightly missed on revenue. So yeah, we kind of see the expectations are going down as the normalization, the supply chain issues are fixing for the chicken egg industry. But this is such a cheap play. Check this out. Look at the market cap in the top right. The company's worth $3.64 billion. That's what the whole company's worth, $3.64 billion. They literally have $1.14 billion of cash and no debt whatsoever. So literally over basically 30% of what you're paying, 30% of the market cap of what you're paying is just their cash on hand. And since they have so much cash, they're earning interest, 12 to 15 million of just interest on their cash every quarter. So yeah, their EPS is expected to go down to a 20 forward PE. It's probably, probably fair at this price. It's not super cheap yet at this price, but if ever there's any bird flu issues, stuff like that, burning of chicken crop farms, this one's just here to benefit. So yeah, let's see. Yeah, chicken egg stock right here. Conventional shell egg sales, specialty egg sales. Yeah, that's down 0.4. It's down 41. So yeah, kind of a normalization happening. So there's a lot of swings for this industry. So that's why you don't want to keep it as a meaningful size position. It's kind of like an oil and gas stock. You wouldn't want to have it as a big size position, but you hold it for when the commodity does good, and you get the massive dividends in the meantime. So yeah, that's what I like about that one. Hey, what's up, Suzuki, man? Good to see you. What is ZBH? I haven't heard of this stock right here. Zimmer Biomet. Okay, let's check it out. The stock is not done too well. The stock is the same price that it was back in 2014. So you bought the stock over a decade ago. It's lower than it was. But the forward PE is a 16. That's a cheap forward PE. What is this? Knees. They sell sports medicine, extremities, hip. So some maybe sort of knee and hip treatment company, if I had to guess. Maybe we can check out their website real quickly. Or orthopedic reconstructive products. Huh. So let's see here. No, hey, reject the cookies. No, they're not getting it. Medical technology. I want to see their actual products right here. So these are, maybe it's a robotics play with that robotics machine. So some sort of like medical device stuff like this. So yeah, they do knee, hip, foot, and ankle. Okay, anyway, we can kind of get the idea of what they do. So they're trading at a cheap valuation, a 16.6, but is it because they're not growing? So they are growing. Look at that. The revenue's up 9.7, but the net income, they're making net income every quarter, easily 150 to 250 mil in net income a quarter. But maybe it's just because the net income's been flat. I really don't know. Decent balance sheet. They bought a company last quarter. Wow, they spent $1.4 billion buying some sort of company last quarter. That's probably why the revenue went up 9.7. That artificially grew that. But anyway, that acquisition is interesting. They make good money, 300 to 400 mil of free cash flow a quarter, 200 mil in net income a quarter. So yeah, anyway, that's an interesting one there. 16 PE. Wish I could give you more thoughts on that one, but there you go. For pork bellies and oranges for eggs. Hey, what up, Bandit? He says COHR is an AI play. COHR. We'll look at like one or two more here. Then I got to run. What up, Eric? Fiverr stock. How's it going? Hey, what up, Applesauce? Yeah, Coremedics came out with some bad future results. They basically lose this government subsidy, which I knew was going to happen, but I guess the stock didn't. So here's Coherent. This is an interesting one. Let's actually see what they do. So any weekly news? Nope, there's no news, but this is Coherent right here. Let's see what they do. So data center and communications. Well, this is an industry that's probably booming. Yeah, down 10% on the day. Yeah, so maybe it's just getting back to a normal PE because the forward PE ratio is a 46, so it's still pretty expensive at a 46 PE, but the expectations are up and to the right. So yeah, look at the revenue. They always beat on revenue every quarter. It's just going to go to 1.69 bill. EPS is supposed to go from 38 cents to 81 cents. So that's good. And EBIT as well. EBIT's just up and to the right. So there's a lot of future growth expected here. They've had a little... The profits were a little choppy from a one-time adjustment, but if you just look at the operating profit, the core profits, this is actually phenomenal news. The revenue's up 17, but the profits are up by 73. They're the most profitable they've ever been. Yeah, they really are growing margins. Yeah, gross margins are up 8% after it grew 17. That's great margin expansion. So deleveraging, look at that. Liabilities were 60% of the assets. Now it's only 40%. So Coherent's interesting. Good future expectations. Still might be a little expensive. So they're in data center communications and also industrial. Interesting there. North America, 61% of their sales. There you go. Wait, SIE. What is SIE? Let me know if you're talking about this Canadian company, Sienna Resources. I don't think you are because this whole company is worth $4 million. Unfortunately, I couldn't find that one. I did check though. TMQ, what's this one? Trilogy Metals, and we'll look at EIX. That's your we'll look at Fiverr and EIX too. 52-week low on them, really. So here's Trilogy Metals, a very small one, an $800 million market cap, but I'm just guessing this one's following the commodity of some sort of metal. They have 5 employees, so this company has 5 employees. The firm holds interest in upper mineral projects, including a copper, zinc, lead, gold mine, copper project. So maybe it looks like a startup. Maybe they had really good results this day that they're finally about to make some revenue. I don't know because there's no, this company doesn't sell anything right now. They've never sold a product or service, so the revenue's 0. They're not expecting revenue for the next 2 quarters. So if we go to revenue, it says no data because they've never sold anything, but they have a fortress balance sheet, literally no liabilities, no debt. So interesting name here. I still be very careful with that one. 800 mil market cap and no revenue yet. No expectation of revenue anytime soon. It looks like EIX. This is your estate you probably don't love to be an investor in. This is the California utility play. Does anyone remember the California wildfires that happened on January 8th of this year? Well, this company got blamed for it. Their utility line, and I watched it live because I've been watching this stock for a while. But it's a regulated utility in California. They got blamed for the wildfires and have to pay a couple bill in fines or whatever. But yeah, their PE is an 9.4 forward PE. If we go to their net income, they pretty much just make around like 500 mil, sometimes more of net income every quarter. You get a great dividend, a 5.5% dividend yield here. But the reason they've just been down ever since is because they have that headwind lawsuit liability coming. It could be a good buy the dip opportunity though, if you're interested in like a California utility. So yeah, is the 5.5% dividend is probably safe. Let's see. So it's a bit of a choppy numbers here, but if we average it out, let's say they make 800 mil in net income a quarter. Let's see how much the dividend cost every quarter. The dividend cost exactly, okay, 360 mil. They actually can afford that. So as long as they're making over 360 mil in net income every quarter, they can afford the dividend. And for the past 4 quarters, they have been able to afford it every quarter. So I believe. So anyway, EAX, that's your California one. Fiverr, FVRR. Let's check out this one. So yeah, dang, look at that. Fiverr's at kind of an all-time low today. I used to own this one. That was 2023. So Fiverr, this is a micro cap, $680 million company. So the whole company's worth $680 million. I remember them having a net cash position, or let's see. So I know they earn interest on their cash. Let's see here. So they have, oh wow, look at that, $560 million of cash. And I believe that earns interest as well. If we go to their interest right here. So yeah, they make around 6.5 to 7 million of interest on their cash a quarter. And that's actually very good because when your whole company's worth, 680 million and you're making 6 mil of interest a quarter, that's a good net income tailwind. But that's also like, if we look at the operating profit, they made 104,000. This is the before tax number. This is the before tax and before interest number. The core business made 100,000, but the net income says it's 5.5 million because it adds in the interest. Which isn't included. This doesn't include the taxes or interest. So every quarter they've been losing money, but when you add in the interest they've been making, they're net income positive. So the core business, basically for the first time in history, the actual Fiverr website turned a profit of $100,000 of profit for the first time ever. The revenue's up 8.3%. They did 100 mil of revenue. And netted 100K, but that interest really bumps up their net income right here. So they just sold an asset. Look at that. If we go to the cash from investing activities, they just sold something, one of their own assets for $250 million. I was wondering how their cash pile went up. Look at that. Their cash went quarter over quarter from 300 mil to 550 mil. I'm like, how'd they do that? Because the liabilities stayed the same. They sold off one of their assets. I don't know what they sold off, but they got 250 mil for it. Huh. It's almost like a cash play. I don't know. I wouldn't own that one with a significant amount of money. Okay. Yeah, Core Medics right there. Speaking of CRMD, they had bad like 2027 outlook. I decided to buy one share for the fun of it, but yeah, this is a stock I've always said you never want to keep this as a meaningful size position. You don't want to have it as a big size position because of what can happen like today. Whoa, Cavco, no way. Cavco's at an all-time high. We bought this stock literally at an all-time high and I made a video about it. I'm like, I don't feel good about this, but now they're up 8.5%. The market is booming. Yeah, CEG, I wish I had cash. I don't have enough cash. I don't want to get to a amount of cash I'm not safe with. And I would so love to buy one more share of CEG. I've already spent all my money 3 days ago, I bought I bought a share of McDonald's for $300. I bought a share of Amazon. And I bought another share of Coca-Cola Consolidated. Actually, 2 shares of Coca-Cola Consolidated. I've been buying the dip. So I've been spending all my money and I wish I had some left over to buy the dip on CEG. They just went through with their Calpine merger. Again, this is your number one U.S. nuclear play. They literally own 30% of all the U.S. nuclear reactors. They were built from decades ago, so they're fully amortized assets, and they just print money every quarter. Plus the EPS accretive acquisition of Calpine that finished today. Are you from Canada? No. Canada taxes the crap out of capital gains. That's what I love. It's super cool. In the U.S., tax hack. I make under 48K a year. I make under 48K, and if you make under 48K a year, people don't realize the tax benefits. Long-term capital gains is 0% if you make under 48K a year. So that means your qualified dividends, like if we go right here to my McDonald's dividends right here, they pay a qualified dividend. Every single one of these dividends, since I make under 48K a year and it's a long-term, it's taxed at long-term capital gains, I pay 0% tax, even in my taxable account, on all this dividend income. I kid you not. And also another cool fact, let's say I took all my profits right now on, well, you have to hold the stock for over a year to get the long-term capital gains. But if so Meta, I haven't touched this in over a year. If I sold all my shares of Meta for a $591 gain, it's completely tax-free because it's long-term capital gains and I make under 40K a year. So that's kind of a cool little fact that the taxes really favor low income on stocks. It's literally all my dividends I get are literally tax-free, even in a taxable account. That's why I don't mind having a taxable account and not fully, I really do need to fully max out my Roth IRA. Though I always recommend maxing out the Roth IRA. 2025, well, you can even still max out 2025. So we deposited 5,500 last year, and I still can deposit more. I need to, but yeah, pretty cool. Okay. Yo, Plasma, you're still streaming? Yo, yeah, we've been streaming for 2 hours and 40 minutes. I've been just having fun. I didn't even realize the time is flying by. I appreciate everyone being here. If you wanted the follow button, we try to stream every single day, sometimes twice a day. So, Larry said HOTH. Let me check out that one if we can find that one. HOTH. Hoth Therapeutics. Okay, let's check it out. Hey, what's up? Oh, and PNG, please. Let's do PNG. That's the Kraken Robotics, right? My bad there, Shill. Pat, and Suzuki Man, what's up? He said, I heard cookies. Yeah. So this stock, you probably don't want to touch this one. It's at an all-time low. If you look in the top right, we don't really cover these kind of stocks. Oh, it's meant to be Siemens. Hey, are you still here? We can look at Siemens stock. You can find me the ticker symbol, and maybe I'll find it for you. But yeah, if you look at the stock in the top right, the market cap, they're only worth $16 million and they're at an all-time low. They're a penny stock. This is why you don't buy these names. So first off, it's a revenue-less startup. If we go to the revenue, it says no data because this company's never sold anything. They've never sold a product or a service. And let me show you, this is the way I like to look at stuff. Here's the market cap. You can buy in at this valuation. You could buy the whole company for $16.8 million. That's how much the whole company's worth, $16.8 million. Let's say you do it. Let's all pitch in $1. No, but the whole company's worth $16 million. Here's what you're buying. You're buying a company that lost this quarter $4 million. And when the whole company's worth $16 million, you literally just lost 25% of your whole investment. After losing last quarter $2 million, $3.5 million, $2 million. So this is the kind of company that, in my opinion, is going to continue to go lower to bankrupt like it has been for eternity. But if they have some results where they're like, hey, we're finally FDA approved and we can finally sell a product, the stock will probably have some momentum and go up on that. But these are the kind of stocks you trade. You don't really buy and hold these because it's almost for sure going bankrupt. So hopefully that was helpful there. Just from a pure analysis, fundamental analysis, you can't justify buying that with anything meaningful. So here's Kraken Robotics. This is a pretty cool one right here. So $2.4 billion company, and they're at an all-time high today. It's a Canadian company, so we're going to convert the currency to USD just to get a bit of a better idea here. But yeah, they sell products and services. I'm assuming, yeah, or 68% of the revenue is from North America, but let's see the revenue here. This is actually super impressive. So the revenue is up 55% to 22 million, and they're actually net income positive on this. Like if we go right here, last quarter, they had a small little hiccup to the profitability, but they're still making on average money every single quarter. Like they're already profitable. Like all the other robotics names you look at they're making revenue like this, 10, 20 mil, but they're all losing money. But this one's is already profitable. So they have a really good balance sheet as well. Their assets just jumped up. I wonder if they diluted you for that. So yeah, they just diluted you by 80 million. But they also just bought a company for 20 million or something like that. Anyway, this is an interesting Canadian robotics play. Revenue is supposed to hit 35 mil next quarter and then 30 mil. So the revenue is going to have a 200% growth rate if they're right. So the revenues are going to go from 11.2 mil to 30 million. So looks like a lot of future growth expected here. It looks expensive, but yeah, they're a new all-time high. That's a better robotics play than like a Rich Tech Robotics. It would be nice if the live were uploaded to YouTube. It is, Daryl. Actually, it is. Thank you for saying that. Yo, that's the only way to support me. I sell nothing. I have no course book. I don't coach. I literally sell nothing. The only thing I do have, if you want to support me, is just a YouTube channel. It's free. Just it's called Nathan Robert. It's also in the link tree in my bio. You can just type into YouTube Nathan Robert. The very beginning of the stream, I think, is very interesting because we fully fundamentally analyze all the Mag 7. It was super fun. So yeah. We've been live for dang 2 hours and 40 minutes. I'm having fun here. So yeah, JEPI, this is a covered call ETF. As we know, the NASDAQ 100, this is the NASDAQ 100, but they sell calls on it. So obviously that's an asset you don't really want to sell calls on because you always get called because it always hits an all-time high. So what you do, this ETF you buy to maximize your dividend income. You're not going to outperform the QQQ or the S&P 500 just because of how selling calls works. But what you do get is monthly income. You get a monthly dividend. Usually these dividends tend to trickle down by double digits every year, so you're not going to get paid the same amount. But you buy this to maximize your income. This is one of the better covered call ETFs. As you can see, it's been flat since 2021. The same stock price as it was in 2021, but you get that 8% monthly dividend or whatever. So yeah, that's a pure way to maximize your income. And it's technically not dividends. You get distributions and it's taxed as short-term capital gains. But yeah. Hey, what up, Plasma? He says, thoughts on Flex. Let's check it out. Ooh, and actually Credo is another one I really like. Hey, Nathan, you mentioned already your thoughts on Cormetics. Yeah, Cormetics, it's one you want to keep as a very small position. And I'm not going to sell out of my Cormetics, but I'm not really going to allocate a lot of new money toward it. I did buy 2 or 1 share. I'm going to buy probably like maybe 1 or 2 more. But I'm just keeping it as a super small position for now. It's not one you want to have as a major size position. So here's Flex. Let's check it out. 19 forward PE. That's pretty fair. Wow. Okay. So it tells me this stock is probably going to continue to climb high. Like it's already done so good. And I think it's probably just going to continue to do well because check this out. The current PE is a 26, but the forward PE is a 19. At this cheap forward PE, like this has the ability to stretch up to maybe like a 22 or a 23 forward PE, sends us up, 30%. But let's see what this company does and if they deserve that 22 PE. And I think they do because, wow, they're beating on expectations every quarter and their expectations are still up and to the right. So revenue's up and to the right. They did miss on EPS slightly, but the EPS is supposed to hit a record, next quarter and the quarter after. The EBIT as well, like every metric is just up and to the right. So, okay, so the revenue is, okay, that's weird. Single digit revenue growth, but it still beat expectations. So look at this, like the revenue only grew 3.94%. So single digit revenue growth, that might be why it's a high teen multiple, 19. That's probably why it's at a 19. It maybe doesn't deserve a 25 forward PE, but maybe could stretch up to like a 22. So Flex Agility Solutions, that grew 4% year over year. And the other one, Flex Reliability, that grew 3.37. At least there is positive year over year growth. But now I can start to see why the multiple's low because the sales growth is slow. But cheap valuation, and they beat on expectations every quarter. So that's great news. Ford versus Ferrari. Yeah, Ford is kind of uninvestable, sadly. Ford's lower than it was in the year 2000. It's actually half the price that it was. But what's the net margin on a Ford? They have a net margin of, let me look on an annual basis because it's so choppy. So Ford historically, like a low single-digit margin, like look at that 3 to 5% net margin. I wonder if tariffs help out Ford, I don't know, but what I love about Ferrari is they sell more. They don't just sell a car; they sell the best car, and it's kind of like the Nike where it's brand value. But look at this one. Ferrari has a 20% plus net margin, so that's what's cool about Ferrari versus Ford. And I actually have been buying Ferrari stock a little bit, dollar cost averaging into that one. So if I was going to buy a car company, I'd buy Ferrari. So they're cool. Okay, we'll look at 1 or 2 more here because dang, we've been live for nearly 3 hours. Phil said Snow looks undervalued right now. Snowflake, actually, this is one of the good actual AI play, like useful AI play. Let's see right here. Snowflake reports strong Q3 revenue growth, acquisition rumors. Really? There's an acquisition level? Okay, what is this right here? Rumors emerged of a potential $1 billion acquisition of Observe, which could enhance. Oh, yeah, I heard about that this morning. They're trying to buy a company called Observe or something like that. Let's see right here. Uh, yeah, Snowflake shares are trading lower after the company announced it will acquire Observe. So maybe it's going down on, maybe it's going to be decreative to the EPS. Like that's the thing, they're already losing a lot of money. That's the one thing that does suck about Snowflake. Here's their net income right here. This is not what you want to see. This company loses 300 to 400 million of net income a quarter. So it's hard to do an acquisition when you lose already 300 mil a quarter. So they're going to have to issue debt to finance this. And they've already leveraged up year over year. But this is still a really useful, like real AI play. And the top line growth is super good. Check this out. So the product revenue right here, this is the main winner. Up 29%, after grew 29, after grew 34, after grew 83. Like it just hits a new record every year, every quarter. It's phenomenal. The expectations of the revenue are up and to the right. Yeah, the revenue is going to go from 1 billion to 1.3. So that's still 30% revenue growth expected. But look at the EPS. The EPS is not going up and to the right. They're still expected to lose. Like analysts know this though. Like analysts know they're going to lose a lot of money. So that's why it's not like some surprise if they lose another dollar of EPS, a dollar of EPS, which a dollar of EPS is, 350 mil in net income. So they're supposed to lose 350 mil in net income for the next 2 quarters, but that's why I wouldn't have it as a crazy big size position. I just don't like that they're still losing so much money, but they're basically the second best to Palantir. It's like Palantir, Snowflake didn't like a UI path, and Snowflake and Palantir are really hooking on to those enterprise cash-rich customers and the government as well. So anyway, what ETF to put on a watch list? I'd like it sounds so boring, but it works. The VOO S&P 500 ETF, most investors, retail investors, and hedge funds cannot outperform the tech-heavy S&P 500. So, hey, Voss said, what platform are you on? Hey, this is actually a brokerage right here where you buy stocks on my favorite platform. It's actually in the link tree in my bio, the very first link there, or you can just type it into Google. It's a brokerage called Moomoo. Yeah, if you want to use my affiliate link, first link in the link tree in my bio there, if you go and deposit $100, we'll both get some free stocks. And it's kind of cool because you get a 3.35% APY on your idle cash. By the way, all these brokerages are all in the link tree in my bio. Robinhood is the second link up there. I just like Moomoo the most because, like with Robinhood, this one also, you get a 3.25, a lower yield, a 3.25% APY on your cash, but you have to pay them $5 a month. Well, this brokerage is completely free, costs nothing, no fees. There is no, Webull as well has a $3.99 a month subscription to get the APY and all these other benefits. I don't pay for that. That's why Moomoo, in my opinion, is my favorite one. And that's why we've been analyzing stocks the whole time on this one, because there's also great analysis tools. Like there's the Nancy Pelosi tracker. Yeah, actually, check this out. We haven't even looked at this once the whole stream. I forgot about this. There's the Nancy Pelosi tracker, Warren Buffett. You can see exactly what they own. You know who just bought Google? We go to new position here. Warren Buffett just bought Google for the first time ever. Berkshire Hathaway did, which was so interesting. Nvidia is so big, they own some individual stocks. Like Nvidia has a huge stake in CoreWeave and APLD and ARM. I love ARM. That's a stock I want to get into. ARM is really a royalty company. Actually, I want to kind of pull that up if I can right here, because I used to break this down for me. Yeah, look at this. So ARM, 60% of the revenue is their royalty revenue, and then the other half is their licensing and other revenue. The expectations are up and to the right, 1.4 billion of revenue expected. And look at their gross margins, literally, because it's all royalty, 98% gross margins. That's some Reddit type margins where it takes nothing to run the company. Anywho, Daniel said Zeta stock. How's HCA been this last few weeks? My employees in the same sector, and they raised our earnings. HCA is one of my favorite stocks of all time in terms of the best fundamentals I've ever seen for a stock. And that's why they're my largest position in my Roth IRA. I actually bought a share of them. That's another stock I forgot to mention. I bought a share of them literally a couple of days ago at 468 on December 31st. Well, I guess that wasn't that. It was kind of a bit ago. But anyway, I just bought another share of HCA. The best fundamentals I've ever seen for quite frankly any stock ever. But there is some news of HCA, there's policy changes. Yeah, hospitals face profit squeezes, policy risk grows. They're removing, let's see, health expected to navigate policy. I wonder, what was it exactly? Yeah, the Medicare for hospitals is going to get cut or something. Anyway, I still love the stock. I'd love to buy them, more of them on a dip. One of the best stocks I've ever looked at. Oh, yeah. Hey, what up, Voss? So Zeta, let's do Zeta real quick. This one just got profitable. Can you do data? Hey, maybe we'll see. Zeta Global right here, 5.7 bill market cap. They just got profitable. I think they just had some deal with like OpenAI. Yeah, Zeta Global formed strategic partnership with OpenAI to integrate advanced AI models into Athena marketing. So that's pretty interesting there. They had like 40 new customers that paid over 100K a year or more in their most recent earnings report. But check out the revenue expectations. This is pretty interesting. The revenue is going to go from 254 to 363. It's like just next quarter is going to be 380 million revenue. The top line growth is phenomenal. Now they are still losing money, but check out these year over year comps. That's why the forward PE looks ridiculously expensive because they just got EPS positive. But these year over year, like they lost 80% less money than the previous year, 55% less, 40. Like this is what you want to see. Everything here is headed in the right direction. Sales are growthy. Revenue's up 25 after 42%. Really good balance sheet, deleveraging the balance sheet. I think they did some acquisition lately, around 70 mil acquisition back there. So like that's what's so cool. Like this growth isn't like growth from an acquisition. It's just organically growing. And I can't believe the revenue is going to be at 380. So you really look at like a 2 or 3 year out forward PE because it's 420 right now. So I don't know what would be, I can't analyze this one too much here. Is there Morningstar research? No Morningstar research. Anyway, that one's interesting software name. Less Medicare or less medical payouts. Yeah, hey, or maybe there'll be less hospitals and that'll, what was that one? Datadog, yeah, DDOG. So let's see, this one got added. I remember got added into the S&P 500 back here, but it's kind of been straight down. I think it's because they can't get profitable. Yeah, so if we go to their net income right here, let me see. Oh, so they are net income positive, but it's like going down, I guess. So that's weird. So yeah, the forward PE, it says it's at 326. The current PE is 423. So, and then 326. So EPS is expected to go 30%, but it still looks expensive. The revenue growth is really good though. Revenue is going to go from 760 to 933. Really big revenue growth expected. EBIT beat like crazy, earnings before interest this quarter. So what about the free cash flow here? Free cash flow is good, 200 mil of free cash flow. And we're really watching the bottom line here because that forward PE is expensive. But as long as they keep up this top line growth, because these kind of software names always trade really expensive, they should be good. Yeah, like if they just keep beating on expectations like this, I do wonder if they're falling just to get back to like a normalization of their valuation. Yeah, down 7% on the day. Yeah, dang, they've been flat since 2021. I don't know if they're like a cybersecurity play. That's the part of software I've loved, specifically cybersecurity, like a CrowdStrike, a PanW, a Palo Alto Networks, because, they're really AI immune or like AI thesis, like AI replacement. Hackers are just going to utilize AI and get better at hacking. So, yeah. How bad does Lucid look in those charts? Yeah, Lucid, you don't want to touch this one. I have tons of videos on Lucid saying this is the kind of stock that's just going to continue to hit newer and newer all-time lows. So yeah, if we go to Lucid right here, this is why you can't touch the company. If we go to their net income down here, this is so sad. They lost $1 billion in net income just this quarter, then 500 mil, 400 mil, 400 mil, $1 billion, like just for all of eternity. These are the kind of businesses I don't want to own. Ones that lose money hand over fist, Tesla cutting prices, they have to cut prices even more. So this one even more super EPS negative. They also are literally diluting. They can't issue debt, so they're issuing shares while the stock is at all-time lows, diluting the life out of the shareholder because they can't afford these net income losses. And they can't issue any more debt. They're already really leveraged. They've leveraged up. Liabilities were 68. Now it's 79. So they've leveraged up the balance sheet. They've diluted you. And the end, like what does this company do? They sell electric cars. And the end game is a low margin commodity. Like the whole end game goal here is to sell electric vehicles for hopefully a couple single digit % net margin, maybe sell some software. Oh, dang, market closes in 10 minutes, closing cross. But yeah, Lucid, you can't touch that one, unfortunately. That's why we always look at financials because it explains why Lucid's at all-time lows. It also explains why Palantir is basically at all-time highs because the fundamentals that's what you focus on. If we look at Palantir right here, this is what you want to see. And this is a stock you trust. You look at the government revenue, the growth is phenomenal. It's up 55%, after grew 32, after grew 10. Like the growth rate is growing on the government revenue and not just the government side of revenue, but also like the commercial side. This was the real impressive number. That grew 73% after 26, after 22. So like the growth rate's growing over there as well. And this one's net income positive. Like they just beat on every metric every quarter. Like this, like find a stock kind of like a Palantir where this just takes so much risk off the table. Like they have a fortress balance sheet, no debt at all, completely debt free, doesn't owe anyone any money, huge safety net. And they also have a ton of cash, literally $6.5 billion of cash. The cash is earning interest. They're net income positive, hitting a new record in net income every quarter. Revenue's up and to the right, over $1 billion a quarter now. Expectations are so good. Like Palantir is an absolute monster, but unfortunately, they have a super high valuation. So, how about Rivian? Is it in the same situation? Sadly, yes, Rivian is in the same situation. Rivian stock you don't buy individually. You buy Amazon to get exposure to this. Like Amazon is the largest shareholder. That is good. Like Rivian's a little bit better off because they have Amazon and Porsche backing them. Like Amazon gives them a ton of orders. Like has anyone seen those electric Amazon vehicle trucks? They look great. Like I want to drive one of those. But yeah, Rivian is kind of in the same boat. Check this out. It's sadly uninvestable because look at this. They lost $1 billion in net income this quarter, $1 billion last quarter, 500 mil, 700 mil. So they're in another position where they have to either issue debt, dilute the shareholder, just not in a good situation. I think Rivian's also like developing their own chip. Rivian recalls 90,000 vehicles in the US due to toe link joint issue. Well, that's usually not a big deal. Rivian reports deliveries down 18%, missing expectations. So I guess that's not good. Anyway, again, a low margin commodity. I wouldn't buy Rivian. Last one, or we'll look at Credo Technology. So, actually, Carter, let's do, what app is this? Yeah, hey, if you want to get this app, or it's actually a brokerage, it's in the link tree in my bio, that very first link there. Well, Elf isn't great either right now. I will do both of those, and then I've seriously I've been live for 3 hours. Oh my goodness. I got to use the bathroom. Basically just been talking in a room. But this is so fun. So here's Credo Technologies. Oh yeah, and if you want to hit the follow button, we stream every day. And so Credo, this company actually is headquartered in the Cayman Islands and pays no taxes. I was actually investigating this earlier. We go to their tax rate right here. The tax rate, is 0 or 1% because they're headquartered in the Cayman Islands, but their products are in such demand right now. Check out the revenue growth, triple digit for the past 4 quarters in a row. Revenue of $268 million, and out of that $268 million of revenue, they netted $82 million. This is what you want to see. They used to lose net income every quarter. Now they're printing money. They're fortifying their balance sheet right here. I mean, look at that. This is just like a Palantir, no debt whatsoever. They have $813 million of cash, and that cash also earns them interest. Where is that? Yeah, $5 million of interest this quarter. They're making $3 to $5 million of interest on their cash a quarter while making $82 million of net income. Expectations are up and to the right. Yeah, they're going to continue triple digit growth because it's going to go from 170 to 350. And they always beat slightly on expectations. EPS expectations are up and to the right. It's going to go from 20 cents to 56. So what's the forward PE on this company? 57. It still might be, that's probably fair, with no debt like that, that's really impressive. Some of the best financial growth I've seen. So yeah, good one to buy. Put on the watch list for sure. I really like that one. Poet is an alternative for Credo Technology. Let's see this one. Credo, Poet. A small one here, 950 mil market cap. Let's see, does this one have revenue? Revenue is, look at that. So they're basically, they're getting revenue for the first time ever. 290,000 of revenue is still nothing. This is a nothing burger. Losing 10 mil a quarter. So yeah, this one you want to be really careful with just because they have no revenue. Are there expectations? I guess 500K revenue next quarter. So you keep the allocation of that one really small just because Poet really doesn't have any revenue yet. But could be interesting there. Okay, last one, Elf Beauty. Someone said, dude, so many bots follow me after I get on your live show. Yeah, please watch out for people impersonating me. I'll never follow you. I'll never DM you. And I literally sell nothing. I have nothing to sell. I don't coach. I have no book, course, literally nothing. Only thing I have is a YouTube channel. That's my only other account. My only other account is Nathan Robert on YouTube. I have no other TikTok. So yeah, That is a real issue. TikTok does nothing about it. So anyway, here's Elf Beauty right here, one of the beauty and cosmetics stocks. They have sadly missed on expectations. This is a high PE stock and they missed on growth expectations. So check out this quarter. Analysts expected 365 million. They only did 340 million. So they missed on revenue and they missed on EPS. They expected 38 cents. They did 5. They've been missing expectations, which isn't good. And that's why they gapped down specifically on earnings day, because they missed on earnings. And the weird part was, you see this revenue growth right here? They missed on revenue, and that's after they did this acquisition. So I'd pay attention to this right here. They lost, they didn't lose. They spent $600 million buying some other beauty and cosmetics company. So they spent $600 million buying that company. That's why their balance sheet, changed so much quarter over quarter, why their assets spiked up by $1 billion. But even after the acquisition, the revenue was only 14%, and that did miss expectations. Luckily, they are still net income positive every quarter. The net income was probably lower than it. Well, actually, no, the operating profit was $7 million. Maybe it was a acquisition-related adjustment. I don't know. We really just want to see them beat on revenue expectations and start to fix their margin. I like that they're still net income positive every quarter. But yeah, this one historically, this one had a lot of growth, because if we go to this on an annual basis, look at the total revenue growth. Like, they were taking market share from like Ulta Beauty and stuff. Revenue was growing like crazy, but they've been missing expectations. Actually, another beauty stock, that's really impressive actually is Ulta Beauty. ULT, I think they're at an all-time high. Whoa, look at that. They are at an all-time high. It kind of shows the difference. We saw Elf Beauty right there kind of missing on expectations. Well, this one has been beating on revenue and EPS every quarter. And check out the bottom line. They make super consistent, like 300 plus mil of net income a quarter. So financials always explain why the stock's doing what it's doing. That explains why Elf Beauty gapped down specifically on that earnings day, because they missed expectations. And this company right here, since they have so much money, look at the buybacks. Ulta Beauty does crazy buybacks at the top here, 200 to 300 mil of buybacks a quarter. And here's what that does to the EPS. So the net income fell by 4.6. Net income's down by 4.6, but net income per share is flat. It's only down 0.00. That's because the share part of the ratio, again, the EPS and the net income should always be the exact same, the growth rate. But since the share part of the ratio went down, the EPS is falling less. It was actually green. Pretty insane. They deserve to be at all-time highs. Yeah, what's the forward PE? A 24 freaking forward PE. This stock's going higher too, if I had to bet. That's a nice one. So anyway, what apps do you use? What app do you use? Hey, Dylan, if you want to get this app right here, this is my favorite brokerage or app to buy stocks on. It's in the link tree in my bio, the very first link there. OBD said Ulta stores are pretty huge. They have a lot of stuff. I wonder how the Black Friday stuff went. Need to watch on YouTube. Hey, thanks for switching over to the YouTube stream. Thank you so much. I really do appreciate that. But yeah, I am going to end the stream here, Dan. We've been live for 3 hours and 3 minutes, one of the longer streams I've ever done. If you want to support me, check out the very beginning of the stream. Again, my YouTube channel is called Nathan Roberts, also in the link tree in my bio. Just type in YouTube Nathan Roberts. The very beginning of the stream is so fun because we really deep dive, the same way we've been analyzing every stock, but even more in-depth analysis, researching all of the Mag 7. We did all the Mag 7 analysis. So yeah, I got to go. Hope you guys have a great rest of your day. Hit the follow button if you want. Please watch out for people impersonating me. I have no course book, nothing like that. Oh, my bad. I didn't get to UiPath there, but I do own UiPath. But yeah, see y'all later. Thanks for being here. I'll be live tomorrow, maybe later tonight. And thank you to everyone on the YouTube stream. Y'all are the best. Thank you so much. Logan, Voss, Daniel, Plasma, Ruben, everyone. I don't know who's in here, but if you're still here. Oh, and if you haven't already hit the like button, it still helps me out, even if you hit the like at the very end of the stream. But I'm sure all y'all